2 years, and unemployment continues to rise. That's your Bloomberg Brief. Lisa?
Yeah, Ira, thank you so much. Look, I love New Zealand. I think it's great. I think actually it's an aspiration of mine to spend some time there. Danny, are we making too much about New Zealand?
Okay, maybe. But I will just caveat that with saying it's an interesting decision that they cut, and they said because it was low risk. I mean, there's so many people who would argue that the Fed should be doing exactly the same.
New Zealand, the new trendsetter. Up next, credit spreads pointing to a soft landing.
We're absolutely in the bad news is bad news type of market now. So maybe a year or so ago, if you got bad news, you could think, okay, maybe that means less inflation. But now it really does mean potentially fundamental problems.
That's coming up next. This is Bloomberg.
There are many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Right now, markets are prepared for another Goldilocks kind of day, basically range-bound on the S&P. That can change. It changed yesterday heading into the close. What you're seeing right now is a dollar weaker, and this really is the key story. The Fed appears to have the ability to cut rates. That is what the market is saying, and that is what yesterday's PPI data seemed to hint at. Euro at the strongest level, crossing through that 110 level. Strongest level going back to the beginning of this year. Under surveillance this morning, credit spreads pointing to that soft landing.
We're absolutely in the bad news is bad news type of market now. So maybe a year or so ago, if you got bad news, you could think, okay, maybe that means less inflation. But now it really does mean potentially fundamental problems. But we're not really seeing that. So we actually still think spreads where they are. Yes, they're not compensating you for a recession, but we don't think there's a recession that's going to come.
Here's the latest. Markets seeing plenty of room for the Fed to cut amid easing inflation concerns. But Justin Dercole, a longtime head of Barclays' fixed income syndicate business, is pushing back, writing, quote, there's an expectation that these higher rates are very restrictive, and we're waiting for the consumer shoe to drop and wipe out the labor market. If that were going to happen, it would have happened already. Justin, who currently is the head of ISO MTS Capital Management, joins us now. Justin Dercole, I want to start with that. Why are you pushing back so aggressively on this?
Yeah, so the beauty of focusing on banks, which is what we do, is we have a particularly strong lens into the economy. And so what we're seeing is that asset quality is actually trending better. And that ultimately, if you were going to get the long and variable lags that get so much attention in the press, they would have happened already. It would be transmitted through the credit channel, Lisa, and that just hasn't happened. So if I am a bank, most of the large banks, all of the large banks really are well capitalized. Their profitability is better than it's been since the global financial crisis. And their asset quality trends are moderating. And so you put all those things together and the banks are going to lend. And so if they're willing to lend, ultimately a consumer that is now getting used to these higher interest rates, you put all that together and overlay a capital market environment that's been very favorable. Credit spreads have been near their tightest levels of the last 20 years, going back a couple of weeks. We've had a little bit of a blip in the last week and a half, 2 weeks. But I put all of that together, and then I'll either turn on the TV, listen to the radio, read the press, listen to pundits, and I really have no idea where people are getting this risk to the economy.
Well, hold on a second, Justin, because I'm sure that you hear a lot of those people here on Bloomberg Surveillance. They come on, the Neil Duddas of the world, we'd love to get you guys in the same room, coming on and basically saying, what is the rush? This is the time. What is the holdup? This is the time. What are they waiting for? Let's go. Justin, how do you sort of dismiss some of the concerns that we're seeing from a lot of corporate executives that are coming out and saying the consumer is feeling weak? What do you say about Home Depot saying that they're waiting for rates to be lower to actually make those purchases?
Right. So I think that's an important point. So the consumer has been waiting. And I think, so if you look at loan growth, it's been very tepid. It's finally started to pick up. If you look at the Fed's H8 report that came out last week, loans are finally picking up. So what I would say is there are two dynamics here. One dynamic is companies and CEOs, if they're having issues, it's very easy for them to point to a consumer that is challenged. And I don't want to say place blame, but effectively use this crutch to help them talk about their challenges. The reality is that, and this last payroll report probably stands out to me the most as being so completely different than what the narrative was. 200,000 workers were impacted by weather. And I don't know how the BLS said that weather wasn't a consideration. I don't get that. It didn't make any sense to me. And so there's almost certainly going to be a get back in the next payroll report based on the weather effects. So here's what I would actually ask the CEOs who are talking about a challenged consumer. The second quarter grew at 2.8%, and retail sales were very strong in June. We're getting retail sales tomorrow. The strength at the end of the second quarter means that the third quarter is almost certain to get off to a strong start. Goldman has a Q3 GDP tracker that they're already out with, and I think it's in the mid-2s. Atlanta Fed GDP now is in the high 2s. So when is the future the present? That's what I want to know, and I really just don't get.
Justin, what we've heard from CEOs, though, if I could just interrupt you for a second, is there are two different types of consumers. What does the Fed need to do for those that are struggling on the lower end, that aren't impacted by the stock market and all-time highs we've seen, because they're not exposed to money markets and stock markets?
Yeah, so there's another issue there that is disconnected from reality. So there is a report from Barclays that came out after Q1. So it's a little bit dated, but I mean, relatively recent. And if you actually look at the underlying spending trends, the lower end consumer actually was doing better in the first quarter from a consumption standpoint than higher end consumers. So again, what I would say is, I'm not sure that what you're hearing is reality. And let me try and put a fine point on that. Okay, if I'm a lower end consumer, wages are growing right now at a much higher rate than they did pre-COVID, certainly, and immediately post-COVID. Okay, so you have better wages. You have a growth in a rise in the unemployment rate. That is because New entrants are coming in. Now, let me ask, so some of it's immigration, but why are new entrants coming in?
Justin,
Because
can I ask another flavor of this? Because you're talking about the strength in the consumer, that the long and variable lags haven't arrived. What do you make of just inflation then coming back down to the Fed's target?
Right, and so therein is the interesting dynamic. If the neutral rate is higher, which I would say, and this is the point I actually think is most important, the neutral rate is higher. At some point, you have to reconcile that. Otherwise, the market is taking down duration, financing this deficit at the wrong levels, at too low a yield in aggregate. And that's a concern. So what I would say about the inflation is that there is an expectation every time inflation gets down here that it's just going to keep going straight down. I don't think that's realistic, and most people agree with that, and yet the market doesn't want to trade it that way. It just wants to assume that it's going straight back to 2%. Last point, let me just make. In 94 and 95, there was this mid-cycle adjustment people talk about. That was after a negative payroll print the Fed cut in 95. So we're nowhere close to that. You're running payrolls after we get this give back. You're probably running payrolls close to 200,000 a month.
Yeah.
It's totally like the narrative and reality are disconnected. It's finally going to come home because at some point the market will have to say, how are we living with a 5% policy rate now for 12 months?
Yeah.
So we have ex post data that supports this idea that the neutral rate is higher.
Justin Derkola of ISO MTS Capital Management, thank you so much. A lot to go through. We didn't even get to what you're doing with all of that, but we'll have to leave that for another conversation. Coming up next, Stuart Kaiser of Citi, Bloomberg's Mario Parker, Marriott Chief Executive Officer Tony Capuano, and former Chicago Fed President Charles Evans. I want to issue up a correction. I was kind of ragging on New Zealand, and I got this message that New Zealand is where the 2% inflation target came from. So maybe they're punching above their weight.
Oh, I feel a little bit vindicated. Thank you to that viewer.
Yeah, so New Zealand is still going to be very much present in our show. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
We are being whipped around on every single cyclical data release.
I also think we're putting a lot of weight on one data point.
I would sit there and say the most important numbers are going to be the jobs report, initial jobless claims, and the CPI report.
I think the market gets spooked about the uncertainties of global growth.
I wouldn't be surprised if the volatility continues for a while.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes until the moment of truth. We are talking about CPI. Welcome back. This is Bloomberg Surveillance from our New York City studios. We have Anne-Marie Hordern. We've got Danny Berger. I'm Lisa Abramowitz. Jonathan Farrow is still off on his week-long jaunt, well-deserved vacation. Right now, we are looking ahead to what CPI will really show in about 90 minutes' time. Danny, the key question in my mind is, how is this market positioned and how leveraged is it still to that Goldilocks story?
That's such a powerful rally yesterday. On what? On PPI, something that usually doesn't move the market. Yet here we are, equities basically doing a round trip where they are at the start of August before we had that major sell-off. So it is a market that really feels ready for a softer CPI. It thinks the trend will continue from last month that saw this violent rotation. So there's a lot at stake today.
Which is the reason why people are trying to understand what the dynamic is between sort of the soft landing and disinflation versus a consumer that seems to be pushing back. It really ignites people's emotions. I mean, we saw that just with Justin Dare Cole saying, what are you guys talking about? This is not a Fed that needs to cut rates. Then you have Neil Dutta saying, what are you waiting for? Cut rates. I mean, the real emotion here, and frankly, data to really back up either viewpoint.
Data and also the commentary, what we just heard from our previous guest, that's coming out of corporate America. But really, the distinction is the bifurcation. CEO after CEO is talking about this softening, especially on the lower-end consumer. The higher end continues to spend. They're going to the Four Seasons, which we had the CEO on yesterday. It's the lower-end consumers that are, to Home Depot's words, are deferring these big purchases. They're waiting to see what the Fed is going to do before they go out and spend more money.
Yeah, we talk about Four Seasons. Where are they expanding in private jet business, not necessarily in terms of going into other particular aspects of the population. So the key issue here is not exactly what the data is, but how the Fed will respond at a time where we have seen inflation come in. Yesterday's PPI print was softer, healthcare costs in particular, leading that downward. CPI is expected to come in 0.2% month over month versus the prior actually decline. Key question in my mind, Danny, given the fact that we've seen that huge rally in two-year yields, we see the euro at its strongest level versus the dollar going back to the very beginning of this year. How leveraged is this market to a perfect outcome that really underscores that the Fed could cut rates by 100 basis points this year?
I was going to say, all you need to do is look at what we're pricing for September. 50% odds that they go from 50 basis points. And the debate at the Fed is just, has inflation even come down a lot? Enough for them to be able to deliver 25 basis points. So the reaction of the market, of course, will be interesting today. But the reaction of the Fed, I think, will be even more telling. If they get a softer print, do they simply just say, okay, we'll cut 25 basis points? Even if that's the case, the market is still off sides.
Well, and Raphael Bostic trying to push back in the same kind of camp that we've heard from others. Right now in markets, kind of doing nothing ahead of that print. You don't blame people considering the fact that everything can change in about 90 minutes time. We also are coming off, as Danny was mentioning, the biggest four-day rally going back to November of last year. The euro, to me, really interesting, going north of 110 for the first time in months, and we're really seeing the highest levels that we've seen since the very beginning of January. Yields continuing to decline across the board, still disproportionately on the front end. 10-year yields 3.827, and crude coming off just a touch after a big rally last week, but seems to be tempering as people start worrying more about the growth aspects, down about a third of 1%. Coming up this hour, Stuart Kaiser of Citi, following the S&P 500 biggest four-day rally this year. Marriott International CEO Tony Capuano on that bifurcated outlook for travel demand that Anne-Marie was talking about. And former Chicago Fed President Charlie Evans ahead of U.S. CPI. Let's begin with the big story. Stocks on hold. Traders are awaiting that CPI data at 8:30 a.m. Eastern. Stuart Kaiser of Citi writing this. Sentiment is edgy as growth slows. CPI may be a modest positive, but carries less weight this month. We are still cautious, but IGV calls screen well for a bounce. Okay, this is counter consensus, Stuart. Everyone is saying that this is the biggest CPI print since sliced bread. Why do you think it's not?
Look, I think the market's kind of shifted its focus a little bit to the growth side of the ledger. I think both the Fed and the market are, at this point, pretty comfortable. Inflation's on a bit of a downward trend. So the inflation print matters, don't get me wrong. But I think if you had a high print, the market might just say, well, we're trending downward. This is normal data volatility. To me, like 0.1 to 0.2% is your sweet spot. I think if you kind of print in that area, that's going to be positive for equities. They'll respond well. The lower print, I think, is where there's more uncertainty in terms of how the market would react to that.
Hold on a second. This is actually really interesting. A lot of people who come on say that the real issue and the reason why they care so much is the Fed can cut rates as long as inflation is coming down, as long as there isn't that inflation concern. You're saying that the bigger concern is that people aren't considering the downside risks to the economy. In other words, an upside print, an upside surprise in inflation, you don't think would actually disrupt this market that much?
I think it would disrupt it a bit, but not the same way it would have, a few months back. Because, the Fed has basically said, we don't need lower inflation data, we just need more of the same, right? So I think that means if you're printing 0.2s, the Fed wants to cut regardless. So I think in that context, an upside surprise doesn't really change the calculus as much as it would a couple of months ago. If you print very low, then the debate becomes, first off, the market will react to that positively initially because low inflation means the Fed, the cuts are kind of baked in at that point. But I think ultimately people might take a step back and say, geez, we just printed, let's say, sub 10 basis points core CPI 2 months in a row. What is that telling us about the underlying demand strength of the economy in that case? So that's why I don't know how the market will react to that really low print, but it'd be very interesting, I think, to see that in real time.
Well, it was that print last month that was kind of the starting gun for this volatility, this trend shift, this change that we saw in markets. And one of them was this false dawn of small caps outperforming. You get this really powerful rally that peters out as the rest of the market starts to freak out. If we get a low print, I know it's hard to judge what the market will do. Could it give another leg to that small cap rotation?
It could. At the time, we had said there's a window here for small cap to work. The problem is it's hard for small cap to work unless you have soft landing data, right? So I think what you had is you had small cap responded initially, then you had kind of some choppy tech earnings, which brought the market at large down. And then you had that softer payrolls print. So if you think of why did small cap respond so positively in July is because you printed 200K and you backed that up with 6 basis points on core CPI. This time you're printing 114K and we'll see what happens on inflation. So yeah, I think a lower inflation print can work, but you really need, in our view, soft landing data for that to happen. And we just haven't gotten that out of the labor market the last 2 weeks.
Well, so okay, if CPI can't really tell us that soft landing data, is the market more coiled up then for retail sales? Is that going to be the more important print this week?
I think you could argue Thursday is more important than Wednesday this week. It's not just retail sales. You're also going to get another claims number, and you also have Walmart printing that morning as well to Emery's point on low-income consumers. So I think the collection of data Thursday might be more important than CPI on a standalone basis. Retail sales is a little tricky. The markets don't tend to trade retail sales that much. But look, everything is context dependent, and in the context of the markets right now, that retail sales claims at Walmart might be actually more important than CPI.
We've seen some outsized movements to data that normally we would just ignore. Do you think the correction is over?
I hope it's over. I would say, we're watching the VVIX, which is basically implied volatility on VIX options. That still remains quite high. And the reason our focus is on that is because the VIX was kind of center of gravity for this sell-off. And we haven't seen that risk pricing completely normalize itself. And until we see that, you have to be a little bit concerned that there's still some positioning issues in the market.
But how are we supposed to see normal volatility when it's, it's August, so there's not a ton of liquidity. We have a very important Fed decision in September and then a U.S. election in November. When will volatility start to calm down?
Well, hopefully this week because it's the end of summer. Look, I think right now you're in kind of a weird spot. You have Jackson Hole, you have DNC coming up. you have a payrolls print that the market's still digesting, and you obviously have some positioning stuff going on that's sort of put risk takers on their back foot a little bit. So that is going to keep, volatility elevated a bit. I mean, what gets it down? A, vacations, that might help, and B, frankly, I think it'll have to be, you're going to need claims data to continue to remain solid. You need payrolls to kind of come in a bit. So it's going to be data dependent, I think.
It sounds like you haven't taken your vacation yet. Is that pretty much correct?
I have not. If I'd known John was leaving, I would have tagged along with him. No, I'm sure.
Shots fired.
Like in Sardinia or something. He's got to be somewhere famous.
All I could say is I tried taking a vacation last week. It didn't work. I am wondering where the most susceptible aspects of the market are to a potential sell-off. We saw, for example, tech stocks reprise their haven aspect over the past week or so. And yet your own Chris Montague came out and said actually he sees tech stocks as being highly susceptible to a pretty big sell-off with any downside economic surprises. Is this kind of the area that you see? Is it sell what you can, or are these areas more susceptible to downside in the economy than people give it credit for?
Yeah, I think I'd sort of break that into two categories. If you're worried about just like kind of hard landing data, I still think you want to focus on that domestically facing cyclical aspect of the market, which is going to be small cap and retailing. Tech to me is a very interesting discussion right now because let's say you got hard landing data, typically you'd want to be in larger cap, safer balance sheet, dividend paying type stocks. That sounds an awful lot like large cap tech. But to Chris's point, the positioning is really, really long in tech. So I think that's the kind of riddle you're trying to solve is in a weaker growth environment, do people go and hide in those stocks? Or in a weaker growth environment, do they have to sell and that's what they own? So they kind of sell what they own and you get kind of a positioning unwind. So ultimately, we're just going to have to kind of see how that plays out. I agree with Chris. I think both the yen carry trade, which has been talked about quite a bit from a positioning perspective, and tech, these are huge, long overweights that have been built up over a multi-year period. You're not cleaning out that positioning in a week. I don't care who's estimating. It's just not happening. So I think that's the risk to tech is that you get a large enough sell-off that people need to degross positions, and tech is what they own, so that's what they sell.
This is an interesting point, especially because we have seen, as Danny was pointing out, in the yen trade, we have seen ongoing strength there. So it's not exactly like that's come off the boil in terms of that particular carry trade. With big tech, are we back to where we began before some of the turbulence last week?
I don't think 100%. I think sentiment did get a little bit dented around large cap tech earnings. Just this idea that if you do get you had core businesses, at Amazon in particular, at Microsoft as well, like their core businesses weakened a bit. And then you had Google talking about potentially a little bit less CapEx. And the problem with that large cap tech universe is it's just a feedback loop, right? I mean, if you're spending on CapEx, you're buying stuff from NVIDIA, and NVIDIA sells you the chip, and it goes in a circle. So I think that kind of I do think there was a little bit of a shot across the bow there on A, the positioning, and B, sort of the interdependency of these stocks. So I don't think it's 100%, cleaned itself up yet. I do think there's a little bit of, kind of worries about positioning and sentiment in that space. If you look at something like NVIDIA, I do think there is a floor on a stock like that. Talking to institutional investors, somewhere in that $90 to $100 range, I think people want to be involved in that stock. But, getting down there hurts. And that's why your vacation got ruined, basically.
I do just wonder when things like that are washed out, because one of the criticisms I hear is not that we got really over-levered on the yen carry trade necessarily, but just the amount of leveraged products. The fact you can go out in the market and buy a 3 times levered NVIDIA ETF is madness in this environment. So, I mean, do you need to see basically the end of those types of products? Because it feels like people are happy to buy them. They're happy to do 0-day to expiry options. Nothing has discouraged people from buying these types of products. So do you just foresee a washout of that to get back to normal?
I mean, it's a good question. I mean, last Monday, 0-day options were 26% of total options volumes. That's half their normal. So you definitely saw, at least tactically, that trade, kind of get put on hold. The lever products, they're not going away. I mean, they've been introduced. People understand them. People want to use them. And, the leverage issue is interesting because there's certain investors, like a vol target fund, for instance, they add leverage not because they want to. They have a formula they follow, and when realized vol is low, they kind of continue to buy. So look, these products aren't going away. The street's aware of them. I mean, we know when the overriding ETFs have to rebalance. What's getting traded in 0-day space. So they're not going away, full stop. The question, I think, is more what you might call discretionary leverage. That might be a retail investor using margin. It might be a hedge fund kind of levering themselves up. That kind of leverage can kind of get pulled out of the system a bit. But these products, I mean, they're here to stay. They're not going anywhere anytime soon.
Stuart Kaiser of Citigroup, thank you so much for being with us. Really appreciate it. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Shares of Kellanova are rising in the pre-market, up nearly 8%. Mars agreeing to buy the snack maker for $83.50 per share for a total consideration of nearly $36 billion. Kellanova makes products like Pop-Tarts, Pringles, and Cheez-Its. It was spun off from Kellogg last year. Since 2020, Mars, which is known for M&Ms and Skittles, has also scooped up snack bar maker Kind's North America business and Nature's Bakery as it expands its snacks portfolio. Shares of Alphabet are lower in the pre-market. Bloomberg is reporting the Justice Department is considering forcing Alphabet's Google to break up after a landmark court ruling found the company monopolized the online search market. The move would be Washington's first push to dismantle a company for illegal monopolization since unsuccessful efforts to break up Microsoft 2 decades ago. According to people familiar with the matter, less severe options include forcing Google to share more data with competitors and measures to prevent it from gaining an unfair advantage in AI products. And the UK's Wizz Air is offering a deal for last-minute travelers. The Telegraph is reporting the airline is offering an all-you-can travel annual pass for $571 a year. The catch? Pass holders can only book to travel 72 hours before departure. It's also worth noting Wizz Air was the UK's most delayed airline last year. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the Harris Policy Platform.
All we're asking for is better wages, better benefits, better lives, and dignity in the work that we do.
That's coming up next. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Coming into a day ahead of CPI, which I'm being told by the likes of Stuart Kaiser and many others, it might not be the most important event of the week. It might be tomorrow, actually, with retail sales and jobless claims. Nonetheless, we are about an hour and 15 minutes away from that read of CPI. Right now, S&P futures completely unchanged. A fascinating, really volatile market out there, not so much. This is a new, very much old kind of summer market. Euro, though, really interesting, climbing some of the highs that we haven't seen for months. 110.24 versus the dollar, but one of the highest levels going back to the beginning of the year. 10-year yields marginally lower. Under surveillance this morning, the Harris Policy Platform.
The only thing those two guys knows about working people is how to work to take advantage of them. That's what they know about it. Every single chance they've gotten, they've waged war on workers. and their ability to collectively bargain to take that away from them. All we're asking for is better wages, better benefits, better lives, and dignity in the work that we do.
Here's the latest. Kamala Harris is set to roll out much anticipated details of her economic policy vision on Friday in North Carolina. A campaign source saying Harris plans to pitch lowering costs for middle-class families and taking on corporate price gouging. Joining us now is Bloomberg's Mario Parker in Washington. Mario, I'm just curious what details we can expect to get or not on Friday.
Yeah, well, we'll expect from our sources that she'll hone in on healthcare, housing, and food costs, how to lower those costs and those prices for middle-class Americans. Part of that platform, we should note, is the fact that the Democratic ticket that she was on with President Biden before she succeeded him, I should say, at the top of the ticket, the message on the economy was just not getting through. It just wasn't cutting through. And a lot of that had to do with what voters felt was a lack of empathy. And so what you'll see, what we expect to see from Harris at least, is that she feels that consumers feel as though the economy isn't that great. The message that the Biden campaign had been preaching was that, hey, the economy is great. And it had been falling on just American voters just hadn't been hearing that message.
But Mario, how does she do that if we've only seen her at these massive rallies on teleprompter? How does she actually convey that empathy that they think Biden was lacking, given the fact that she is tied to the Biden-Harris administration?
And that's the irony, Anne-Marie. She's got a new lease on political life in some ways, even though she was on this ticket as his vice president. And this is to the frustration of the Trump campaign as well. Voters seem to be getting, at least based off of polls, giving her a fresh lifeline. They're not keeping her, they're not tying her to the economic, the economic report card, if you will, of the Biden administration. So she's got a fresh slate to reintroduce herself now. And you're seeing her take advantage of that with these rallies, and then we're seeing her take advantage of that with this rollout on Friday.
Is there concerns, given the fact that Bidenomics could mean something great if you're a Democratic voter, or very negative if you're a Republican and even some independent voters? Is there a concern within the Harris campaign that Joe Biden should not go on the trail with her?
We haven't saw that concern. I mean, that's a great point that you raised there. I will note that they will debut debuted on the trail tomorrow for the first time since Harris has taken the top of the ticket. They will be in Maryland tomorrow. Whether or not, to what extent Joe Biden, one of Joe Biden's his favorite phrases is, however he could help you, either campaigning with you or campaigning against you, he understands the politics of it all.
I do just wonder what you make of the sentiment of the moment, Mario. Anne-Marie was great talking about yesterday that we had small business confidence coming in at a 2-year high. And small businesses tend to skew not Democrat. This tends to be a group that is unhappy as long as a Democrat is in power. When you look at these kinds of surveys or these polls around how people feel about the economy, how much faith should the Harris camp take in them?
Well, they should take some faith, right? To your point, it's not necessarily that they need to win that block, right? They need to just lose less. So you're not going to necessarily turn around a historical trend in one election, but what you want to do is decrease your losses there or increase some of your support within that group. That's another way to look at it. And so there's some good economic news that's come out for the Harris campaign over the past week. Another is that in a Financial Times poll, for the first time, she surpassed Trump on the economy. That was one of his strongest topics on the campaign trail.
And in the meantime, you know, it benefits Harris to have this kind of, I don't know, very classic Democrat, nothing too controversial. And in the meantime, Trump is trying to pin her down on many lines. But one consistent one that they've been saying is she's not talking to the media. She needs to sit down for an interview. Do we have any movement from the Harris campaign and how they'll thread that needle? Not saying too much, but maybe getting at that criticism that, to be fair, isn't just lobbed at her from the Trump camp, but from the media as well.
Yeah, so the irony, right, that Trump is pushing for more media access. But the thing is, they need content. They need her to sit down, the Trump campaign, that is, need for her to sit down. As I mentioned earlier, she's got this new lease on political life. So they need fresh fodder, and they're hoping that that would be generated from some type of public media appearance. listen, they're trying to run out the clock as much as they can, but they won't be able to outrun this topic. From what we understand from the campaign is that she will do an interview at some point within the next month or so. We're not sure what that looks like. We're not sure what setting that will be. We're not sure who that will be with, but she will have to do that within the next month or so.
In the meantime, Mario, just on the other side of the ledger, I'm wondering about Donald Trump, and we did see him have a rally after the assassination attempt on his life. I am wondering, though, why we haven't seen more. Is that something that it's expected, or do we have a sense of whether this is sort of a connected issue, kind of how he's getting his bearings, given some of the changed landscape?
Yeah, well, he'll have a rally today, actually, in North Carolina. This will be his first time in a swing state, I should note, in about 11 days or so, nearly 2 weeks. Before that, he did have that press conference at Mar-a-Lago on Friday. He had that appearance online with Elon Musk earlier this week as well. Some of it is he was fundraising in some places also, and then some of it is also just a function of just how much this race has changed over the last 3.5 or so weeks with Harris at the ticket. The Trump campaign, for all intents and purposes, appears to have been caught flat-footed. Some of the engagements that they had pre-scheduled already were in states that weren't swing states necessarily. He appeared in Montana to campaign against Democratic Senator John Tester, for example, which was, again, a vestige of the campaign from a month ago, where he was strong enough to essentially save everyone else around him, or at least attempt to save everyone else in the party. But now, with the polls showing that in some ways Harris has either drawn even or surpassed him, it's time for him to get back out there in the swing state and shore up his own prospects.
Bloomberg's Mario Parker, thank you so much for being with us. And I will just say, predict it right now. If you take a look at the betting markets, which we're evidently not supposed to look at, Liz Libby Cantrell said until after September, have Kamala Harris at 59% versus Donald Trump at 45%. What are you watching, though, to parse through the noise, Anne-Marie?
It's just fresh momentum that her campaign has right now. And what Mario said is this new lease on life. I would look at it as Harris basically closing the race, but it is a coin toss. It's 50-50. The Cook Political Report, that's how they view it when they recently moved Arizona to a coin toss, when before it was lean Republican as opposed to a few others. He mentioned that FT poll. You got to look under the hood. Still only 1 in 4 registered voters say economic conditions are excellent or good. That's not great.
Yeah, which is a reason why I think that one poll that came out of the FT was pretty interesting, suggesting that maybe that wasn't the case. We'll get the new kind of view on that coming up next. Marriott International President and CEO Tony Capuano with summer travel season in full swing. We were talking about that just with Stuart Kaiser. This is Bloomberg.
What's happening on Wall Street?
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We're just here getting travel tips for Stuart Kaiser so that he knows where to go on vacation. Welcome back. This is Bloomberg Surveillance. Pretty much nothing going on in terms of the index level ahead of the open and frankly ahead of about an hour away, that CPI print. You are seeing, however, a little bit of outperformance from the Russell 2000. Again, this sort of goes to the question of whether we can get disinflation without a growth scare. If you look at where this is going on the bond world, you can see those lower yields sticking after a pretty rip-roaring rally last week. Two-year yields are down some 30 basis points since the end of July. Right now, continuing that trend, although barely, 392. You can see the 10-year also in a similar vein with a 30-year, 10-year at 382.95, and the 10-year, 30-year at 441.43. So basically, if you bleed this through, what we see in the currency market, it is a strong euro. It is a weak dollar. In fact, the strongest euro that we've seen going back to the beginning of January, which raises the question, how much is this entirely a dollar story hinged to the Fed? Under the surveillance this morning, Axios reporting that U.S. Secretary of State Antony Blinken has postponed his trip to the Middle East over uncertainty about the situation. Blinken had been scheduled to leave for the Middle East yesterday. And Marie, what do we know about where these negotiations are, as well as some of the conversations about how the U.S. views some of the ceasefire talks to staving off some of the expected violence from Iran?
Well, Biden was asked about this yesterday, and he linked the two together. He said, that's my expectation in terms of if a ceasefire agreement was reached, potentially would that mean that Iran would hold off on its retaliation. So you see the U.S. really flooding the Gulf with not just the weapons and security in case they do have to come to Israel's defense, but also with people. Brett McGurk is going from Cairo to Doha. Amos Hochstein is in Beirut. And then my expectation would be that Secretary Blinken would go on that trip, even if it was delayed. So you see a lot of effort being placed in the region right now
to try to prevent some kind of altercation that has a pretty high chance of some sort of accident and unwitting escalation. Meanwhile, sources telling the Bloomberg that the Justice Department is considering a rare bid to break up Google. The Android operating system and the web browser Chrome are the units that would be most likely to be impacted. This comes after a court ruling found that the company monopolized the online search market. Danny, a real question about how much this is actually being taken seriously. The market isn't reflecting a massive kind of sell-off, although the shares are down 1.4%. Still, this highlights something we've seen for a while, this desire to see a little bit more competition at the top.
Right, because I think even if Google isn't told that they need to break up, there are still really big ramifications. I think a great corollary for this is 2000. Microsoft loses an antitrust case, but doesn't have to break up. They appeal that, fine, they don't have to. But what then happens is they can't exert their dominance in the way that they once did. And it meant a lot of these young companies, like at the time Google, could really rise up and be a big threat to them. So even if Google doesn't break up, if it's kind of hemmed in its ability to really exert dominance in things like AI, for example, that does mean you could see some serious competitions in other areas of tech.
And this is not going to end. This is a bipartisan issue right now in Washington, D.C. J.D. Vance talked about over the weekend when he sat down one of the number of Sunday shows and reminded everyone that actually the antitrust case on Google started under the Trump presidency. presidency. And this is an individual who has said that actually he thinks Lena Khan is one of the individuals in the Biden administration that's doing a pretty good job. So when it comes to antitrust and trying to bake up some of these big players, this is going to be an R and a D issue.
Meanwhile, Atlanta Fed President Raphael Bostic saying he's looking for, quote, a little more data before supporting a rate cut. He's added that he's encouraged by recent inflation readings. So question about the little more data in about an hour time and whether that will give him that confidence. We will also be speaking with him coming up in Jackson Hole. Our survey for that CPI print calling for another modest increase last month. The consumer really is in focus here, and it's really a host of data earnings that really are coloring the picture. The travel space, a growing list of companies are warning of a slowdown. Marriott cutting its full-year outlook, expecting weaker demand in North America and China. Marriott International President and CEO Tony Capuano joins us now. Tony, always wonderful to see you. Thank you for being in the studio. You know, I want to start, I feel like the U.S. consumer and the Chinese consumer are two completely different stories. So I want to start with the U.S. in terms of the greater weakness. Is it across the board, or is it this bifurcation that we just keep seeing? Higher end still spending, going nuts, lower end really crimped.
Well, there is certainly a bifurcation across consumers. The lower end consumer is feeling the pressure of economic headwinds. In fact, while we don't operate in the economy tier, they actually had negative revenue per available growth in the second quarter. But as you move up the chain scales, we are seeing continued strong RevPAR growth, really across segments and across geographies. In fact, the strongest growth we saw in Q2 was in the luxury segment. And so that luxury customer continues to spend, continues to have confidence, and continues to prioritize spending on travel and experiences versus hard goods.
Can you give a sense of, in the non-luxury segment, where consumers are pushing back, what they're not willing to spend on in the same way that they were, say, a year ago?
Yeah, so it's really interesting. If you look at our Q2 numbers, with the exception of Greater China, which I know we'll talk about, we saw strong growth across every geography and across all three segments we operate in: business transient, group, and leisure. So it's not that we're seeing really a pullback in travel. We are seeing a little bit of a level of caution in some of the related discretionary spend. So when you look across most of the markets we operate, food and beverage spending, for instance, was down a bit. So those consumers, it appears, are still prioritizing travel, but maybe they're being a little more judicious on their spending as they travel.
Well, Tony, you've been with Marriott for a few cycles, joining in 1995. I wonder, when you look at the consumer now and some of that concern, that pickiness of what you're seeing, how similar or how far away does it look from past downturns?
I think, well, from a macro perspective, not terribly dissimilar, other than the trend I just mentioned to Lisa, which is we have great credit card partners in American Express and JP Morgan Chase. And so we have really rich consumer spending data to evaluate. And pre-pandemic, you saw some of the younger demographics starting that shift away from purchase of hard goods towards experiences. Post-pandemic, it really appears to be across demographics. And that's a trend that seems to have the legs to endure long beyond the end of the pandemic. So I think that's a distinction. For Marriott, we're a different company than we were in different cycles. A higher percentage of our business is franchise versus managed, so you don't have that incentive management fee volatility. Higher percentage of our revenue comes from non-RevPAR related sources, like our branded residential business, like our branded credit card business. We're much more international than we were in previous cycles, but there are certainly some similarities.
And you have yachts now.
Now we have yachts. In fact, Ilma, our second yacht, launches next month.
Well, I'm just curious about this idea of investing in luxury. How much of this do you say, this is just of the moment, this split we're seeing, or we want to buy more boats? We want to have Marriott private jets in the sky. What does it mean to either just continue on the trend or double down on it?
Well, the good news is we're not buying any of it. You know, we're an asset-light model, so we have terrific partners who are investing meaningfully in luxury. And we want to lengthen the lead that we enjoy in luxury. We've got the industry's largest luxury footprint. We have the industry's largest luxury pipeline. We have the industry's largest luxury branded residential business. And yacht is just a natural extension of that. We find that luxury customer wants to spend a higher and higher percentage of their travel wallet with the brands that they really trust. And when we look, again, it's more anecdotal because we've only been in the water for 2 years, but more than 50% of the passengers have never cruised before. And so I think they look at that Ritz-Carlton brand as a little bit of a housekeeping seal of approval. And more than 75% of the passengers we've had are Bonvoy members. And so that 210 million member loyalty platform really gives us a channel to talk to them about our expanded offerings.
Before I move on to international, because I want to ask you about the Chinese consumer, I want to ask you about Hawaii. And I know you have a lot of concern. You put a lot of effort into rebuilding what was going on in Maui after the wildfires. Is tourism coming back?
It is. You know, we just passed the one-year anniversary of those horrific fires in Lahaina. I had my whole leadership team in Maui just last month. The great news is the Army Corps of Engineers is to be applauded. The progress they've made in cleaning up Lahaina, preparing Lahaina for redevelopment is really encouraging. We had the commander who's running the effort give us a tour of Lahaina. There's a house under construction, which was really important symbolically. But the aloha spirit of Hawaii is as strong as it's ever been. Our people are passionate, they're resilient, they're excited to see tourists coming back. But they're still operating at occupancies in the 60% range. And so if your viewers hear nothing else, go to Hawaii. They need the business. It's as attractive as a destination as it's ever been.
So who is traveling right now? We spoke to the Four Seasons CEO yesterday who said the Americans are out there and they're traveling. They're seeing weakness with the Chinese consumer. Is that similarly what you're seeing?
Yeah, although interestingly, the high-end Chinese consumer is traveling a great deal, but they're not traveling in China. So when we reported our second quarter earnings, the highest submarket we had in terms of year-over-year RevPAR was Japan. RevPAR in Japan was up 21%, and a lot of that was driven certainly by American travelers, but by high-end Chinese travelers.
But also, how much is that driven by the weakness we've seen in the yen? And consumers, travelers want to take advantage of that.
That's the case. But I think that outbound Chinese traveler was locked down in a really significant way. And you've seen the Chinese government create visa-free travel across the APEC region. And so we're seeing strong outbound Chinese travel in Japan, Thailand, those sorts of destinations.
As an American company based in America, does it give you pause to keep the footprint in the size that you'd have in China, given some of the overlay of tensions between the two countries, as well as the lack of appetite to go beyond that APEC region by Chinese wealthy travelers?
Well, I have an expectation eventually they will come back. If you think about pre-pandemic, the growing middle class in China and their appetite to explore the world was one of the things that drove a lot of optimism across our sector, and I think that will come back eventually. To your first question, we've got a little more than 500 hotels in China today, nearly the same number in our pipeline, and almost the entirety of that portfolio is owned by Chinese companies. And so I'm not sure we're necessarily viewed as an American company in China because the assets are owned by the Chinese, and they love global brands like Marriott. And so, of course, our business thrives in times of political stability. And when you have ratcheting up tension between the U.S. and China, that's not great for travel. But our demand levels in China are back to pre-pandemic levels. The reason we reported such weakness in RevPAR is because of rate. And rate is soft, one, because a lot of the high-end Chinese consumers are leaving China to travel across the region. And the booking window, because of weak consumer confidence in China, believe it or not, is under 3 days. And so they're making those decisions very close to travel for in-country travel.
So just to tie this all together, I know that Marriott had a subdued kind of outlook going forward in terms of how quickly you can see some sort of normalization or at least reversal of what we've seen, particularly in the lower end consumer. How deep do you think some of the weakness goes, the reluctance? I mean, is this just a matter of economic uncertainty, or is this something that you're seeing escalate in a more significant way?
Well, I think your term normalization is the right one. Remember, we saw our business drop by more than 90% in the early days of the pandemic. So for the last couple of years, you've seen demand come roaring back. The benefit of those really favorable year-over-year comparisons has faded, and we're settling into a more normalized demand environment. Weakness in the consumer obviously hits our business. We operate in a cyclical industry. But I think everybody's waiting for September, and if the rate cuts that are expected materialize, that'll be a boost for the consumer. Obviously, I'm going to be watching you at 8:30 to see what the inflation numbers look like. But all of that factors into that mindset of the consumer. But the thing that gives me confidence beyond the next quarter or two is this almost sociological shift we've seen with this appetite for travel. And I think that bodes really well for our business.
Tony Capuano, thank you so much.
Pleasure.
Always wonderful to
Anytime.
have you on the show. Marriott International President and Chief Executive Officer Tony Capuano, thank you. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Germany's public prosecutor has issued an arrest warrant for the suspect alleged to be involved in the 2022 attack on 2 Nord Stream gas pipelines. German authorities have been unable to bring into custody the suspect, who is a Ukrainian diving instructor currently living in Poland. The suspect told the German media outlets he was surprised by the accusation and denied being involved in the attacks, which damaged both strings of the pipeline in the waters near eastern Denmark. Japanese Prime Minister Fumio Kishida won't run for a second term as leader of the long-ruling Liberal Democratic Party in September. Kishida said in a news conference he will devote himself to supporting the new leader selected through the presidential election. Kishida's successor will be Japan's 3rd prime minister since the late Shinzo Abe stepped down in September 2020. And Apple's main manufacturing partner for its iPhone said it expects revenue to grow in the current quarter and for the rest of the year. Hon Hai, also known as Foxconn, reported a 19% jump in revenue for the quarter, surpassing estimates. That boost helped in large part by its growing business of supplying data centers with servers containing NVIDIA AI accelerators. Plus, a pickup in shipments of the iPhone in China have reversed a slump in recent months, a boon for Foxconn. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, counting down to CPI.
You still do have inflation that's above target, but I think inflation risks have really dissipated. And so I think the Fed should be very comfortable cutting rates.
That's coming up next. This is Bloomberg Surveillance.
The top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
We are seeing a market that is in deep wait for that CPI print coming up in about 45 minutes time. You do see, though, the real action today is on the currency front, with the euro the strongest versus the dollar going back to the beginning of this year. Under surveillance this morning, counting down to CPI.
You still do have inflation that's above target, but I think inflation risks have really dissipated. And so I think the Fed should be very comfortable cutting rates. So if the Fed were to go by 25 basis point increments rather than that, yields would rise. Maybe you see equities come down a little bit. But I'm skeptical that the Fed, being a little bit more hawkish, is going to tighten financial conditions aggressively. And the reason is the only way that they would do that is if the economy is looking resilient. And I think the market is highly leveraged to negative news on the economy.
Here's the latest, less than 1 hour away from a crucial inflation report, the first of 3 key economic data points that'll set the stage for the Fed's next rate decision on September 18th. Charles Evans, former Chicago Fed president, I'm so pleased to say, joining us now. Charles, thank you so much for being here. I want to start with really the debate that we've been having on the show this morning, which is the Fed behind the curve or ahead of the curve if they cut rates in September?
Well, good morning. That is a great question, and I think the Fed is in an okay place right now. I think that they have spent a lot of their time indicating that they need confidence that inflation is going to be on a sustainable path to get to 2% inflation, and I think that's a stiff performance bar. I think back in January they were nervous that so many people thought that many rate cuts were ahead, and then the inflation path in the first quarter was bumpy, but they appear to be much better. The last press conference, Jay Powell indicated that inflation progress was welcome. And, everybody's expecting a better number this morning. So I think they're in a position where they can respond to the improving inflation data and, the normalization in the labor market and a bit of nervousness with the fact that unemployment has gone up. But I think that it's time for them to, really start talking more about how they're going to act and actually act.
Charles, you have the luxury right now of not actually having to represent the Federal Reserve, and you could talk about what your impression is of market positioning. So let's go there. The fact that the market has pretty much full confidence that the Fed is going to cut at least 3 times, probably 4 times this year, 100 basis points of rate cuts. We were speaking earlier with Justin Cole, who basically was saying, why? There is no sign that they should be cutting rates given the fact that the economy still is strong and the labor market hasn't turned over. What's the argument to go now, given that we're not seeing a negative print on jobs creations?
Well, the funds rate's at a restrictive rate of 5.3%. They set that in July of last year, and inflation has come down. So by its real measure, it's only gotten tighter since they took those actions. Inflation has come down. If you look at a bunch of benchmark policy rules that the Fed looks at, they don't follow them necessarily. I mean, they certainly don't follow them in lockstep, but they're a guide as to where policy likely would be headed. And they are far south of where we are right now. I think I saw something where John Taylor said that his rule says that the Fed should be at about 4%. That's quite a long ways. Jay Powell has said that the labor market is normalizing, and they seem to have more confidence that the labor market is only normalizing and not doing worse than that. Even though the unemployment rate has gone up, it's 4.3%. Now, maybe the most recent increase was for some positive factors like increases in labor force, but it has increased by, substantially. And the unemployment rate usually it either goes up or it goes down. And when it's going up, it usually keeps going up. And so it would be, quite sensible from a risk management standpoint to sort of take an initial action and step down somewhat from the restrictive level of 5.3%.
Along with what they should be doing, there's also a matter of what they should be saying. And at least from the more hawkish members, Bowman, Bostic, kind of pushing back, saying we need more evidence. Charles, you take this view that your fellow peers, that they aren't guiding well at this moment. What would it look to be guiding better? What would you want to hear from the FOMC at this moment?
Well, I think so the Fed is really relying on this rhetoric that they're not about to cut rates until they have confidence that inflation is going to come down sustainably to 2%. The Fed doesn't have a lot of experience with maintaining sustainable 2% inflation. We kept inflation under 2% at 1 3/4 for a number of years. If that's the definition of sustainable, then I can understand why they need the restrictive stance of policy in order to be confident. But I don't think that's what they really mean or they should mean. And I think that the increase in the unemployment rate has got to make you a little bit nervous. At 5.3%, the Fed doesn't have a lot of history of being able to, they don't have any history of being able to cut the funds rate at a measured pace in these 25 basis point increments on a quarterly pace that the SEPs have. What you have more likely at a peak funds rate like this is January 2001, where all of a sudden they realized they needed to be nimble and cut by 100 basis points within 2 weeks. And in January 2008, where we cut by 125 basis points in the course of 2 weeks as well. And so I think it's just risk management that you would want to step off of this really quite restrictive 5.3% stance and as nimbly as possible communicate that this is just sort of a readjustment and you've still got your eyes on getting inflation down. It's just you don't need as much restrictiveness as they have in place now.
Well, one of the kind of criticisms that's lobbed at the current FOMC is this idea of recency bias, that they were behind when it came to try and combat inflation on the way up. So that sort of scars from that moment means that they don't cut as soon. Charles, you've been in the room where these decisions have been made. Do you think there's any credence to that argument?
I think that, you know, one part, people often say, you know, you need to be humble. The Fed needs to be humble. There's a lot of uncertainty out there. I think part of humility is being embarrassed when things didn't go the way that you thought they did. And so when inflation went up to 7% on the PCE, and I was part of this in the committee, and I was saying this looks like it's transitory. It's, you know, it's not going to last. It's not, you know, it was persistent. It was very persistent, but it has come down. It has come down without unemployment going up. The playbook normally would have been you really need a downturn in order to get inflation down from 7%. We're at 2.5% on the PCE, core PCE. That's remarkable, and it's because of an unwinding of the supply factors. And so I think that it is difficult to look past the fact that I think they had their eyes on the ball. I think Jay Powell, in increasing the funds rate very quickly in 2022, got ahead of the curve. Certainly got on top of the curve better than the other foreign central banks. But it's hard to give up on this idea that you let inflation get away from you in 2022. Gosh darn it, you just got to get it down to 2.0 and it's got to be sustainable. I think that's very aggressive, but that seems to be what they're thinking about. I'm not in the room with them, and I'm trying to understand from their communications what they really mean by the sustainable 2%. And I think they could use some clarifying on that.
Charles Evans, former Chicago Fed president, thank you. We will try to get some of that clarifying for you and for everyone else. Coming up in the next hour, Gargi Chowdhury of BlackRock, David Kelly of JP Morgan, and Stephen Rasciuto of Mizuho, as we do count you down 35 minutes away from CPI. Dana, you know, do you wonder how much the CPI print could shake up markets that are really attenuated to this idea that the Fed can cut rates?
Yeah, they front run themselves, certainly with that PPI, if not from the weak labor market. 200 basis points worth of cuts priced in for the next year. What happens if the number's hot in just a few moments' time?
The reason why few people are taking bold bets right now, given the fact that the market is pretty much unchanged, where you do see action, a weaker dollar, as people anticipate, regardless of what happens. This is a Federal Reserve that's going to cut rates. This is Bloomberg.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever, S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why should I want to invest in the pharmaceutical industry? Is it going to continue to grow as it did last year? And what about your own company? Do you think it's going to have good growth prospects over the next couple of years?
I think the reason to invest in the sector is the science. I mean, when you look again, if I go back into the history, for most of the last century, we were only giving people pills and small molecule drugs. Then we discovered that we had this whole world of biologics, and we could treat diseases with biologicals. More recently, we've discovered that we can reprogram your cells, we can edit the genome, we can use these RNA therapeutics to completely transform areas of medicine. Those technology areas are at their very nascent stage, and what we're going to find is they're going to open up whole new areas of growth from our business standpoint and a human health impact standpoint. We hope that as we work in our areas like cell therapy and RNA therapeutics, we will also be able to climb to a whole other level of market cap over time.
I'm not really concerned at all about inflation staying too high.
You still do have inflation that's above target, but I think inflation risks have really dissipated.
Inflation expectations are slowing down with the economy.
You see slower growth, which is a necessity to cool inflation.
The restrictive aspect of policy is working. I think we're going to see a moderating in inflation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
30 minutes until U.S. CPI. Welcome back to Bloomberg Surveillance, where we're counting down to one of the key data points that we get this week. Anne-Marie Hordern, Danny Berger, I'm Lisa Abramowitz. John Ferro is off this week. He'll be returning on Monday. We are about 30 minutes away from that key metric at a time when a lot of people are saying, Danny, and I think this is really the key question that we've been having all morning, is the bond market overpricing how much work the Federal Reserve has to do to keep this soft landing on track?
And I'm really interested in what the reaction is of this bond market. If it's 3%, 2.9%, if we see 2.9, do we get another big leg higher in this rally in this bond market? And does that make sense? If inflation is coming in, it doesn't mean recession. And the bond market is screaming recession, maybe not screaming, loudly saying recession at this point. JP Morgan says the market's pricing in 30% odds of a recession. Is that in line with reality, regardless of what CPI does today?
And one thing that's been hard for, I think, all of us to square, and I think, Anne-Marie, you've done a great job of bringing this out with pretty much every consumer conversation that we've had. Is it sustainable to see the higher end, the wealthier individuals continuing to do just fine and be able to travel and spend, where the lower income classes are increasingly having difficulty in pushing back in the consumer spending realm?
Well, you see this in the polls, right? Inflation is the #1 issue going into election. This is the first of 3 CPIs we're going to get before November 5th. But when you hear from corporate earnings, Mohamed Al-Arian always said, listen to what corporations are saying. What are the CEOs saying? They're saying that they're still seeing that resilience on the upper end. The resilience is really starting to crack on the lower end. And I think that's why this CPI is really important.
Although maybe not enough to bring down inflation, which is sort of the key metric as we look forward to this. At a time when we already have seen a pretty big move, let's take a look at some of these moves. In the 2-year yield, we have seen 30 basis points of decline since the end of July. We have seen a 4-day winning streak on the S&P 500 that has been the biggest going back to November. We have seen some of the biggest tech names deliver incredible performances. I'm thinking, for example, of NVIDIA with a 17% gain in the past week alone. This has been the other sort of existential angst, Danny, which is how much are we right back to where we began before that sort of volatility really got kicked off?
Well, the volatility is also just kind of the point, even though we're back to where we were. And you can see that clear shift in the markets from all calm, from every day kind of inching up to a new record. That stopped last month when we got the CPI report. The CPI report was that threw everything kind of into the wind, where you get a big, powerful small cap rally that undoes itself. You get 2-year yields going from 4.5% to under 4%. So it was a change in this market as we try to grasp onto trends. And as we try to do that, there's just this incredible chop. So does today help us find the direction? Does today help us? Or maybe it's just tomorrow, Lisa. Maybe it's just retail sales and a jobless claims print that we really should be caring about.
Or maybe we just won't get direction for a while, which is the unfortunate reality that we've been in for quite some number of months. Coming up this hour, I'm so pleased to say we've got Gargi Chowdhury of BlackRock as markets do hold steady ahead of that CPI print. Steve Rasciuto of Mizuho on why he thinks the U.S. economy is still healthy. And David Kelly of JP Morgan on why the Fed's 2% inflation target is within reach. I love having them together because they kind of oppose each other with respect to where we are in this recovery story. We begin with our top story. CPI out in just under 30 minutes. The S&P 500 notching a 4-day winning streak as traders anticipate another soft data print on the back of PPI. Gargi Chowdhury of BlackRock saying this: the risk to the market remains hotter than expected inflation data and weak retail sales that would put the Federal Reserve in a bind. While growth risks have increased, we believe the market has overreacted to a small number of soft data points, not a drastic change to the macro outlook. Gargi joins us now. And Gargi, I want to dig into that a little bit. Where is the biggest overreaction right now in markets?
Good morning. It's so great to be here. Thank you for having me. So I think that the overreaction, especially in the beginning of last week, was certainly in the massive repricing we saw in the bond markets with the warp screen pricing in all of those 50 basis point cuts, which just did not seem likely given just the week before that we had heard from a very resolute Chair Powell that they're going to be dependent on the totality of the data. So I think, obviously we've unwound some of the moves. That's great. As you know, we've liked fixed income for a while. Even with us having liked fixed income in the belly of the curve as much as we did, it felt like too much was getting priced in terms of, Danny, as you were saying earlier, the market screaming recession risks. And frankly, when have we ever cared that much about the ISM number, right? So I think there was a little bit of an overreaction, and thankfully it has unwound. So now looking ahead, I think what we need to see is continuation in terms of that inflation easing, which we'll see in 26 minutes. And I think we'll continue to see that the labor market is moderating, but not falling off a cliff. And I think that's what's going to drive equities and bonds from here.
What's the bigger risk today to markets, considering how people are positioned, that we get an upside surprise or a downside surprise to inflation?
The bigger risk, I guess it depends on how you're thinking about bigger risks, but I suppose for the equity markets, if we get a very shocking high 0.3 print, and God forbid a 0.4. Again, that is obviously not the expectation across the street. Everyone's expecting sort of a softish 0.2. But if we meaningfully overshoot that, I think that's going to be a problem for the equity markets and bond markets. And then if we follow that with a retail sales that's a little bit cooler than expected, and the market's already expecting a cooler than expected retail sales, but if it's even weaker than what we've seen, I think that is a big risk to the markets. And let's not forget, we're still in the midst of some geopolitical risk. There can be headlines anytime. We still have elections, not that far away, which historically hasn't been good. This is the weak seasonal period for equities the next couple of months. So I think there is a few risks out there.
Gary, I mean, that's so many things to even just keep track of, let alone just trade on. In these moments where the pendulum swings so fast, and there are other risks from the outside, geopolitical, that could potentially impact things, what do you even do? Is there somewhere that you can hide during this noise?
Yeah, so what we've been telling investors to do is sort of hide in the highest quality parts of the market. So the one thing that we saw last month after CPI was this, after the weaker than expected CPI, was this huge bid to small caps. And at that point, we didn't feel that was appropriate. And again, if today we get a softer than expected CPI, if the same thing happens, I would still say favor up in quality. And then I would also say that look for some downside protection, especially over the next 6 to 8 weeks, given how much we've rallied in equities. And we've talked a little bit about buffered product. We've talked a little bit about minimum volatility. We've also loved owning the belly of the curve. So I think all of those still make sense. I would just say that between now and call it October, November, I think we might continue to see a little bit more volatility than we've historically seen, especially the last 8 months of that straight line upwards.
That bond call I find in particularly interesting, because it is this tension of maybe we're priced as rich as we can be at this moment, but people are still hiding out on bonds. Last Monday, when we had the wreckage in the equity markets, people fled to bonds. So how do you think about the interplay between the two?
Absolutely, and this is such an important question, because on one hand, I talked about how too much was priced in the very front end. On the other hand, I've been on this show before and talked about how the long end of the curve doesn't have enough term premium priced in. So where you want to be focused is sort of that belly, which is the 3 to 7 year part of the curve, which is what we've been telling investors, and also focusing on active investment, where you're putting your money with a portfolio manager that can rotate between high yield and emerging markets, or CLOs, and other parts of the market that are attractively priced and getting you a significant income. So I think looking at investments which are in that belly of the curve still makes sense. I think the front end moved quite a bit. And I also think, and this is important, some of that negative correlation to equities is coming back. And we certainly saw that in the bond market last week. And that's great news for investors. I think there's a lot of money on the sidelines. You're not going to keep getting that 5% that you were getting in cash. It's time to step out into bonds and high quality equities.
Gargi, you brought it up, so I want to go there. You mentioned the uncertainty ahead of the U.S. election. We've had mixed reviews from individuals coming on the program saying whether or not last week we actually saw an unwinding of the Trump trade. Do you think that was some of it?
I think that last week was all about the unwinding of the carry trade. I think that was one thing that was loud and clear. It was the yen carry trade that got unwound. I don't necessarily think it was an unwind of the Trump trade. I do think that as of right now, when we look at what the yield curve has more or less been doing, not every day, but the steepening is something that makes a lot of sense regardless of what happens in November. I think that's going to probably continue to be the case, and you can point that to Trump, you can point that to Kamala. I think I don't think it matters one way or the other. I think the steepener is a trade that we like. Broadly, what we're telling investors to do is sort of focus on areas of the market that are a little bit more bipartisan. So things like infrastructure, things like tech independence, those we think are going to win in a variety of outcomes. And I think that we also need to tell investors that historically, going into elections, we've seen a little bit of volatility. So stay invested through the volatility, but stay invested up in quality.
You mentioned what you're telling investors. When you walk in the room, is this the first, second, third question they ask you?
It's the first. It's definitely the first. Maybe not last week. Last week it was the 11th. But usually it's one of the things that is top of mind, especially in a world where cash is yielding 5.3%, right? So when investors and clients are allocating to cash, that's an investment decision. That is not a I am so scared decision, which was the case in COVID when cash was zero. So what investors are asking, what clients are asking is, well, I'm doing so well in cash, and we have election risk, and we have geopolitical risks. So now what? And I think it's all our responsibilities to make sure that they understand that if you're investing in cash now, you might not get in 1 year what you are getting today, because we all expect cash rates to be lower. And then the other thing is you are giving up on these other really ripe opportunities, especially in the belly of the fixed income markets with something like BINC that you can get 6.5% to 7%.
Just to sort of put a bow on this, if we do get a soft CPI print and we do see that the Fed does have a green light to cut rates in September, how much cash do you see flooding away from money market funds into bonds, into either the belly of the curve or into corporates or even into risk assets?
Look, July was a fantastic month for inflows into fixed income ETFs, and this was just the beginning, we think, of investors continuing to pour into fixed income. And again, it can be the belly, it can be longer end, just moving away. What we also know is that in the US right now, there's around 5 trillion, globally around 8 trillion of cash. Some of that will remain, but some of that will eventually recognize the opportunities. And I think if July gave us a little bit of an insight into what the rest of the year, especially when the Fed actually starts moving, I think this can continue to be a really great year for fixed income.
Gargi Chowdhury, thank you so much for being with us. Gargi Chowdhury of BlackRock joining us here in New York. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. The world's biggest single owner of equities reporting a strong performance in its investments for the first half of the year, with a big thanks to big tech. Norway's $1.7 trillion sovereign wealth fund reported returns of over 8% in the first half as stocks surged. The fund, which owns stakes in nearly 9,000 companies worldwide, said that it paired its stakes in Meta, Novo Nordisk, and ASML during the first half of the year. A spokesman announced the fund will now release updates on what is in its portfolios twice a year. Global oil prices are rising after an industry report found a sizable drop in U.S. crude stockpiles. The American Petroleum Institute reporting inventories shrank by 5.2 million barrels last week, according to people familiar. That would be the 7th straight weekly drop if confirmed. Elsewhere, risks remain that a retaliatory strike by Iran on Israel may lead to a spike in oil prices. The U.S. said that the probability of an attack has increased, that it could come as soon as this week. And activist investors are pushing hard for sweeping changes at Southwest Airlines. Elliott Investment Management has nominated 10 of its own candidates to the board of the struggling carrier. They include the former heads of Virgin, WestJet, and Air Canada. Elliott has previously demanded major changes at Southwest, including ousting CEO Bob Jordan. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, the morning calls, plus Steve Rasciuto of Mizuho as we count down to CPI. That's coming up next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
13 minutes and 7 seconds until that key report, the CPI, that may or may not move the dial. Right now, markets pretty much in a range as they anticipate that key data point, 54.60. Just amazing how much we've retraced. I want to just take a second on this, Danny. The idea that we have rebounded entirely the volatility that we saw and then some, that we saw NVIDIA up more than 17% in a week.
It is madness. It's also madness within that time period. You get NVIDIA swinging intraday up a couple billion, down hundreds of billions, and then you get Japanese stocks that suffered their worst day since 1987, less than 2 weeks ago, and is back around. It is flat. To see that kind of volatility and just take a step back and say, if you were on vacation, you would have missed it, is kind of an insane thing. It's kind of insane because so many people said volatility clusters will continue to get it, and we just haven't.
Insane or wonderful, pick your poison. Time now for the morning calls. First up, Wedbush upgrading Chipotle to outperform. The analyst saying the chain can sustain market share gains in a challenging macro backdrop for restaurants. Next up, Baird upgrading Starbucks to outperform with a price target of $110, calling incoming CEO Brian Niccol an exceptional executive, inciting his brand management expertise. And finally, Citi cutting its price target on CrowdStrike to $300. The analyst saying reputational damage from last month's global IT outage appears contained. U.S. CPI just moments away. Joining us now is Michael McKee, Bloomberg economics and policy correspondent. So will it be 0.2% or 0.21%? How big of a difference will it actually make, Mike?
To the Fed, it won't make a whole lot of difference, but the rounding numbers could make a difference to the markets in the way they interpret this off the top. Obviously, people will go through these numbers and reposition themselves, but every time we get a number, it's like a roulette wheel. We're waiting to see where the ball drops. You're either on red or black, and then you trade on it. So, yeah, that could make a difference. I think the biggest thing that people are going to look for is, do we see continued progress in the areas in which the Fed is wanting to see continued progress, like housing, and the other issues like airfares and used cars and things like that. So if inflation continues to show some progress, that's going to be good enough. We don't have to have what we had last month, which was a big surprise lower.
Talk to us about sort of the confidence that we can take in CPI numbers. And I ask because every single month, every single CPI day, Paul Donovan at UBS comes out and says, these numbers are made up. OER equivalent rent is a fantasy number. Why are we still paying attention to that? Yeah. If we look at the CPI numbers now, how much confidence should we take should they come in softer?
I was reading Paul's comments earlier, and the only thing you have to say is, yeah, OER is kind of a made-up number, but it also works the other way. I mean, it pushed inflation up, maybe inaccurately, when we were going through the higher inflation time, so it kind of works both ways. But there is a good point there, and that's one reason that Jay Powell emphasized Supercore, services without housing in it, because we know that the housing numbers are kind of weird. And Supercore has come down a lot as well. The question is, what do we see this month? And it only becomes really important this month in the sense that everybody's waiting to see what Jay Powell will say next week, which may be informed by what happens today. And then we get another CPI before the next Fed meeting, so this isn't going to be dispositive.
Mike, when it comes to potentially, is it the fact that they need to see lower inflation data or just more inflation data? Because Stuart Kaiser is saying how that's one reason why he doesn't think this CPI report is actually that important. They just need to see more of the data, as long as it's not completely out of bounds.
Yeah, I mean, I think that's true. Even the hawks are making the point that, yes, we can cut rates if the data continue to show us what it has been showing us. And that's the expectation, that we will see continued progress, even if it's only incremental.
Michael McKee, stay close. We're going to get that data in just about 9 minutes' time. Right now, ahead of that, we've got Steve Rasciuto of Mizuho. We are so pleased to say on set, ready to go. So really, the key question for a lot of us, and we've been debating this all morning, how important is the CPI print?
This morning's number, not particularly. I honestly think this Fed has opened the door to cutting rates as wide as you can open it. They have gone through 3 iterations of opening the door. First, they raised the inflation target. That would be consistent with cutting rates. Then they lowered the unemployment rate. That would be consistent with cutting rates. And then Jay Powell basically said, or Jerome Powell basically said, that all we need to do is see data stay where it is and we can cut rates. The interesting thing is the market's reaction to that, and then the the pushback that's come from some other members of the committee. I think when you're looking at what Jerome Powell keeps on telling you, and you'll contrast it to the policy statement, there is a difference of opinion within the committee, and Jerome Powell is clearly lining up on the dovish side of the committee.
Does that difference hold them back if they need to cut in a month, which is seen as highly political? Do they need everyone in agreement if they are going to be cutting in September of all months?
I think the chairman really would like to have a unanimous decision. I don't think he wants to go into a meeting and have more than one dissenter from the decision, especially because of the proximity to the politics, especially because some of the statements that have been made by, former Federal Reserve presidents of New York, Bank of New York, a supposed principal economist in the Federal Reserve System. These kind of, statements have amplified the political nature of this. And therefore, I think he would like to have unanimity in the process in order to decide this is something that was not a political decision.
To get that consensus, what do we need to see in the data?
That's a darn good question. I think a decline in terms of the year-over-year growth rates would be very, very helpful for them. But you remember, we're still in the threes on the year-over-year numbers in this particular measure. We're not in the PCE deflator. But again, that PPI number that came out yesterday argues that some of the key components of the PCE number that come out later this month are not going to be as friendly. And year over year, we're starting to move higher in the PCE numbers. So I think what we're getting into is a very tight window where, the prospects of cutting rates have increased dramatically because they really have wanted to cut rates forever. And they get to the point where they sit there and say, well, if we don't do something, then what are we here for? And that's kind of the position they've gotten themselves into, unfortunately.
So if you're not necessarily intimately connected to the alphabet soup of PCE, PPI, the different components, et cetera, there is this sort of bigger takeaway that actually makes all of these points very relevant. And the reason why I care so much about them is that essentially there is a debate right now. Are we at a greater risk of a reacceleration in inflation or outright deflation even, akin to what the problem was before the pandemic? How much are you arguing that it's still reacceleration versus the disinflationary spiral that a lot of people were gotten used to saying was actually a negative thing not so long ago?
Disinflation, global deflation pressures are real. You don't have to go much beyond the top line of the news services reports on the different countries around the world and what they're experiencing to see that. The question is whether or not it gets translated into U.S. inflation. And this is where the currency becomes critical. And if you notice, yesterday was a pretty disappointing day for the currency. We moved to some exceptionally low levels. So the currency could easily offset the global deflation risk because that's all concentrated in goods prices, where services are driven by domestic forces. And domestic forces are being driven largely by the labor market. And this Federal Reserve wants to keep a labor market very tight. So you argue that there is this great debate that's going on between the domestic cyclical inflation and the global deflation. Which way we pan out? Unfortunately, it's up to the currency.
It's a great point, especially when we have the euro 110.27 versus the dollar, which is the strongest level going back to January 1st. And frankly, there's a lot of debate around this in terms of globalization and what that does. Vanguard just put out a really good paper on that, questioning the sort of disinflation of globalization. We don't want to get into that right now. Steve Risciuto of Mizuho will be sticking with us. Michael McKee also. All coming up next, we will be breaking at CPI. David Kelly of JP Morgan will be joining us with Steve. We love having them on. They can go against each other about where the balance of risks is for the Federal Reserve. This is how we're stacked up. Ahead of that print, we're expecting a 0.2% CPI month over month. That is up from negative 0.1%, but still on that downward trend, potentially opening the door to the Federal Reserve's rate cut. This is Bloomberg.
What's happening on Wall Street?
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We just have seconds to go before that CPI print. Here is the state of play heading into that. Not a whole lot going on in markets after a pretty eventful 4-day streak. We are seeing, though, a little bit of a pop across the board. The Russell 2000 outperforming, and this is the reason why. 2-year yields continuing their descent, as well as across the board, although actually picking up a little bit, just fluctuating there, 394. Right now, we do have the economic data with U.S. CPI coming out. Here is Michael McKee.
And economists got this one right, bang on. 0.2 increase in the core, 0.2 increase in the headline, just as forecast. Now, base effects are somewhat hard to measure, so we do see, even though we're in line with the headline number, we see it drop on a year-over-year basis to 2.9%. From 3%, that is better than expected, and 3.2% on the core on a year-over-year basis, that is also better than expected. And that may have to do, and we'll look this up, with the rounding that Lisa was talking about before we came on. Taking a look at some of the numbers here, we see food prices up 0.2, same as last month. Food has really come down as an overall issue. Gasoline prices were flat on the month. We saw in the PPI, remember, that gasoline prices were up, and that pushed overall goods prices up. New vehicles down 0.2, and used cars down 2.3%. Those are kind of as expected by analysts. Shelter costs up by 0.4. That's double what we saw in June. We'll have to see how that breaks down. I'll take a look at that while you guys check the markets, but that could be something that maybe worries people a little bit if it turns out to be in the home price area.
We'll give you a second to go through some of the details right now in markets. Hard to know exactly what to do with this. That's my takeaway, although marginally a little bit of a pop on the S&P 500. Bond yields kind of fluctuating, although a little bit higher. Right now, you do see an ongoing pop in that Russell 2000. Danny, that to me really stands out with the idea of rate cuts. This not necessarily impeding the prospect that the Fed will move in September.
I think here you kind of see the clear divide of how we went into this. The fact that you had bond markets in the front end rallying so much, it's undoing some of that. This morning, the front end is moving higher by about 4.5 basis points, which you wouldn't think if you saw small caps taking off. So maybe it is just the fact that we did see, I don't know, some differences in between bond and equity markets, that you did see bonds, again, price in already some very, very significant Fed cuts. So maybe it needs to undo it with a report here that's, I don't know, basically in line.
Yeah, basically not a lot of dramatic action, and euro dollar pretty much staying around that 110 zone. Mike, you've had a couple of seconds. You get a couple seconds here on camp surveillance to parse through the numbers. What stands out for you?
Well, in terms of this housing question, it isn't particularly good news because the Fed had been hoping we were now going to see a series of lower inflation levels. Shelter, as I mentioned, comes in up 0.4. Rent up by 0.5%, and owner's equivalent rent up by 0.4, which is a reversal of the decline last month to 0.3. So housing a little bit more expensive, and it is not what the Fed wanted to see. I'll continue to parse through this while you get the reaction of people who are smarter than me and certainly better looking, and we'll see what else we find.
All right, well, joining us right now, we've got David Kelly of JP Morgan alongside Steve Risciuto of Mizuho. David, thank you for being on with us. I want to start with you. What's your reaction to this?
I think it's pretty good news because if you look at what's, first of all, it was slightly better than consensus in the headline. I mean, very slightly. But if you look at what's still holding CPI up, we got a 1.2% increase in auto insurance. So it's still at an auto insurance anomaly there. And we did, we did see a 0.5% increase in rents, but that's showing the rental numbers up over 5% year over year, and owner's equivalent rent up over 5% year over year. Now we know that that is somewhat misleading, and I think the auto insurance number is also somewhat misleading. But everywhere else, inflation is nowhere to be seen, and I think that's really the important point. Where in the actual transactions markets of the economy, where people are sort of bidding and asking for in terms of prices, inflation is disappearing. So I think that overall, this very much confirms the idea that inflation is heading down. I think over the next 2 months, we're going to have some relatively easy comps. So I think that by September, the Fed may actually hit its 2% year-over-year number on consumption deflator inflation. We'll see what happens. But overall, I think this is further confirmation that inflation is gradually whittling away.
So inflation problem dead. Steve Risciuto, your take?
Complete opposite view. I don't think you should ignore things like what's happening in insurance rates. I don't think you should ignore things like what's happening in the housing market. I think what you're really looking at is an index. You take the index for what it is. You don't parse through the components, throw out what you like, throw out what you don't like, keep in only what you like. This is a problem that we have over and over again. This is a problem we have with people who want to look at a particular component like an unemployment rate or a yield curve and make macroeconomic forecasts out of it. The reality is it's a little bit like Chicken Little getting hit in the head with an acorn and saying the sky is falling. The reality is these are individual components, but they're individual components of a larger aggregate set of data. And that aggregate set of data is telling you, A, the unemployment rate is still low, B, wage gains are still happening in the economy. Inflation is not near the Fed's target. It's still 1 percentage point above it at the CPI level. At the PCE level, it is lower. And it's telling me that we have an economy that is still very, very healthy. So, again, they want to cut rates. They're probably going to cut rates in September because they've opened the door wide enough to, bring a Mack truck through it, or should they bring the Queen Mary through it. And the net result is they'll get what they want. But at the end of the day, is it going to have much macroeconomic effect one way or the other? To be honest with you, it's going to affect financial markets much more so than the underlying macroeconomic environment.
David, I just want to give you a chance to respond to that.
Yeah, well, as Steve and I have just got a slightly different view of this. I don't think this is an inflationary economy. I realize the labor market's tight, even with the unemployment rate up at 4.3%. But what's remarkable is how much wage growth has fallen very steadily all the way since March of 2022. And what that tells me is it doesn't matter how tight the labor market is. American workers are just not demanding huge wage increases. They're just not doing it. We're not seeing massive numbers of strikes. We're not seeing massive industrial action to try and get wage increases. Wages are still rising more than inflation. But if you look at core goods, if you look at food prices, you look at energy prices, none of it shows inflation picking up. So we're heading back towards 2%. Inflation is cooling. It's cooling slowly. But I think the greater risk right now is the Fed. I think the economy is in a soft landing. It's in a good place. But if I'm the Federal Reserve, I want to try to get back to normal here because the risk of recession, I think, is greater than the risk of any resurgence in inflation.
David, not that this is a competition between you and Steve, but if the market had a vote, it would probably be voting with Steve right now. Front-end yields are moving higher by about 5 basis points. You're looking at equities giving up on their gains, except for small caps. That, to me, seems like a market that is saying, hang on, maybe the Fed can't cut as much as we thought it was going to. What do you make of that reaction?
I think, well, the thing is that I do work the details on all these numbers, and I was kind of surprised the consensus was as optimistic as it was in inflation. But I think people are looking for, at this stage, they want, okay, if we get a negative surprise in inflation, then maybe we can price in some more Fed rate cuts. If we get something close to expectations, then we'll sort of sell the news. And I think that's what's probably going on in the bond market. But it doesn't change my view that things are weakening here and on the inflation side. And the really important thing then is, where is the economy looking when we get to September? Because we'll get another inflation report, but importantly, we're going to get a jobs report for the month of August, and that's going to be really crucial here. Because if it looks like the economy is softening too much, I think the Fed can look at these inflation numbers, they can study them, they can be confident they're going to head towards 2%, but they don't want to be responsible for holding rates too high for too long and helping trigger more economic weakness. And so I think they'll be looking very closely at what's going on in the labor market and on the demand side of the economy.
So Steve, David says the risk of recession at this moment is greater where we are than the risk of inflation reacceleration. Do you see that completely different?
Yeah, I don't see a real risk of a recession whatsoever.
But do you see risk of reacceleration of inflation?
If you wind up with an accelerated economy, the answer is yes. And that, I think, is the risk in this scenario. This economy really hasn't slowed much. Look at the GDP numbers. Yeah, we've slowed from last year's 3.3% number, but we continue to exceed expectations in terms of where we're going in the second quarter numbers and what we're looking like eventually in terms of where we are in the current quarter. The Atlanta Fed nowcasters are at very, very high rates of growth. And this becomes an ongoing problem, is that you do run the risk of a domestic cyclical story versus a global deflation story. And this really is the end result debate. We were talking about it earlier. This is the discussion, deflation versus cyclical inflation, globally versus domestically. Where do we pan out on this? David's right. Inflation has been coming down slowly. It's coming down slowly primarily because there is this real battle going on between these two forces. And the problem I see is if you start backing away from the pressure that's allowing you to achieve your target, you might wind up creating an environment where you stop improvement towards your target.
But what would you say to corporate CEOs that continuously say they are seeing this slowdown from consumers? They do see consumers deferring big spending.
Again, after an environment of 3.3% growth, which is a 1 percentage point above trend, you're going to see that inflection point. And that's a real inflection point. By the same token, you have services where spending is doing exceptionally well. And I think that becomes part of the problem. Again, it's the goods versus the services side of the equation. Services are doing extremely well. You're seeing that in some of the components that people want to throw out of the CPI report. The reality is it's services that matter domestically. It's goods that matter globally. Globally, it's a deflation story. Domestically, it's a cyclical inflation story. The currency sits in between the two, and where the currency goes from here will be critical. If we get back to 100 on your DXY measure from having been as high as, 113, 116, that's a huge depreciation in the currency, and you could start to see some of these benefits on the good side of the inflation dissipate at the same time that you may see a little weakening in the service side of the inflation, and you wind up stuck at 3% inflation. Now, if the Fed's willing to be stuck at 3% inflation, fine. Bonds have to adjust to that.
David, we'll let you respond in just 1 second. I just want to, if you are just joining us, give you a sense of where we are right now. CPI month over month coming bang in line, as Mike was saying, with forecasters' expectations 0.2%. Up from negative 0.1% in the prior month. Across the board, ex-food and energy 0.2% in line. CPI year over year coming in at 2.9%, just a touch below the expectation, and ex-food and energy 3.2% bang in line. All of this really suggesting forecasters are getting it right. Mike has been looking through the details, the line items that we can debate whether they matter or not. What are you finding in terms of interesting nuggets?
Well, I think part of this plays into the whole political campaign season that we're in now. Insurance prices are very mixed. We do see motor vehicle insurance prices going up significantly. And if you look at X, formerly known as Twitter, I think you said that yesterday, a lot of complaints about that. But homeowners insurance is flat on the month. Medical insurance down just a little bit. So it's not a universal situation. Airfares were down by 1.6%. So if you're traveling, you're going to notice that. And overall, it is housing that has pushed this up. 90% of it was the 4/10 rise in owner's equivalent rent and shelter. And that the Fed can't do anything about. So they're going to have to decide, they'll go back to Powell's ex-shelter measure and say things are getting better. One other political thing, and I know Anne Marie will appreciate this, bacon prices down 1.1%. So that was, I guess, a big issue on one of the candidates' public appearances this week.
If bacon was on your bingo card, here you go. Thank you so much, Mike. David, Kelly, and Steve Rasciuto still with us. David, I want to go back to you. And there is this real question about the line items and how much they actually matter versus just the overall aggregate index pointing to a certain type of scenario. What gives you confidence that we are not at risk of reacceleration at a time when, as Steve says, the dollar is actually weakening, and as the Fed is likely to cut, weakening even still?
Well, a falling dollar, although frankly it'd be a good idea if the dollar came down in the long run. It wouldn't, I think the dollar's been too high for too long, but that would add a little bit to inflation. But this is not an inflationary economy. Let's just pick up on airline prices, because I think that it sort of exemplifies the exact nature of the U.S. economy right now. Airline prices are down 2.8% year over year. But if you look at the number of people going through TSA checkpoints, it's up over 5% year over year. It is at an all-time record high. Americans have never flown more than they are flying today. The planes are all packed, and yet the airlines can't actually push up the prices year over year. They've had to push down their prices 2.8%. So, I know Steve is a little more worried about inflation going up. I'm a little bit more worried about the economy slowing down. But so long as we disagree in that way, the truth is the economy is just doing great here. What we're seeing is steady, low inflationary growth, with inflation gradually coming down, and hopefully the economy avoids recession. I do think the Federal Reserve ought to normalize rates to try to remove that risk, because I think they are distorting the economy by keeping rates a little too high at the short end for where the economy and financial markets are. But overall, this economy is in a pretty good place, and I hope that Steve and I are similarly disagreeing as vehemently in a few months' time, because that'll probably say the economy is straight down the middle, doing fine.
I mean, you hear that from the Fed, to be fair, as well, this idea that the economy is doing fine and they have time, and that means that they can just wait for more data. Steve, you look at this data, is the wait over? Do they have everything they need to cut?
If they could get a unanimous agreement, they will cut interest rates, yeah. And I think you would need something on the labor market to do it. I think, we're arguing today over the CPI number. I think they've already taken that out of the equation. I think it's all about the employment numbers. And the claims numbers, we'll see what the retail sales numbers give us tomorrow. We'll see what the claims numbers give us. People aren't getting fired. What's happening in the unemployment rate is people are coming back into the labor force. They finally used up all that excess savings that most of my colleagues on the street thought they had used up, a year ago and hadn't used up. The reality of the situation is the transition that's taking place from a very abnormal recovery period to an expansionary period is going to be volatile. And reading through all the tea leaves, trying to look at one or two indicators, makes an enormous amount of mistakes. What's important is the breadth of the data within the payroll employment report. It's like the breadth of the data within the JOLTS data, and I'm not a big JOLTS fan. It's the overall aggregate interpretation of the data. And this is what the chairman's trying to bring out. But by the same token, he also then wants to hang his hat on a particular component within a report to say, oh, well, this is what I'm looking at. But the reality is you can't have it both ways. And that's what they're trying to do. And I think that's what the markets are trying to do. They want the Fed to cut rates, and they want the Fed to cut rates a lot, but we don't want the Fed to cut rates too quickly that people begin worrying about a recessionary environment, and then the equity market goes down. So we want to craft an environment where bonds go up in price, equities go up in price, and everybody can go home happy. Doesn't always work out that way.
To that point, David, of whether or not the Fed likely they're going to be cutting in September, but now the debate is, do they go 25 or 50? If you think we're closer to the risk of recession than a risk of reacceleration, do you think the Fed needs to go 50 basis points in September?
I think I would like them to go 50 basis points, but only if they can message this as being part of a normalization, because honestly, rates are in the wrong place and they need to get to normal at a reasonably rapid pace. I think that's what they ought to do. But they have to message it that way, because the problem is that, as Steve said, if the Fed cuts 50 basis points and does it because they are scared of the unemployment rate going up too fast, it won't speed up the economy. It'll scare people. It'll cause people to halt business decisions. It will cause people to wait for lower rates before they borrow money. It will reduce the income for people, the $6 trillion in money market funds out there. So the problem is there's a J curve in monetary policy. When you cut rates, it actually hurts the economy before it helps it. And that's why they've got to be very careful here. Of course, the truth is they shouldn't be in the wrong place. They should never have raised rates as high as they did, and they should try to get back to a normal short-run interest rate of somewhere in the range of 3.5% to 4%, and just stay there. But I do think that that, you know, I think the employment report for August will be crucial here. I do think they ought to do 50 basis points, but I think they ought to try to message that as, look, the economy is fine. We're just getting back to normal at a reasonable clip here. We're not going to draw it out over a year and a half. We'll try to get back to normal a little bit more quickly than that. If they do that, I think they're managing the situation well.
Well, David, I guess what I don't understand then is if we're 50 basis points and we have more room for that, is that not sort of like an emergency cut? I mean, isn't 50 on its own something you wouldn't do if the economy is healthy?
Well, we didn't really have an accelerating inflation problem at all in 2022 and 2023. The inflation rate was coming down after June 2022, and we saw plenty of 50 basis point rate hikes. So I think the Fed has to sort of desensitize the economy a little bit, say, look, you know, just don't freak out here. Big moves in short-term interest rates don't seem to have much impact on economic variables anyway. So let's just get back to normal. But it's a close call. I mean, the thing that I wish they'd started earlier, because then they could have started based on, look, inflation is steadily heading back towards 2%. We're very confident we'll hit 2%. We're going to take off the brakes here. They ought to start doing that earlier, because I agree that if it looks like they're doing this as an emergency rate cut because the economy's in trouble, that's only going to weaken the economy. So they have to be very careful in messaging. I think it should start with expressing some confidence based on today's numbers that the inflation situation is on the road to 2%.
Steve, just final word, 30 seconds, your view on 50 basis point rate cut in September.
There's no way, given the dots, they can message that properly. Remember, this is a committee that went from several rate cuts before the end of this year to 125 basis points. And now we're talking about, oh, gee, in September, let's go 50. What are the dots going to do? Are we going to get a number of people on the committee to turn around and say, oh, I'm going to reduce the dots? Are they going to be able to do that? They don't talk about the dots in that direction. So the reality is, if they go 50 basis points, then the question is, what changed so much that you only had one, that now you have two and you're doing it all in one shot? And then what happens to the additional meetings for this year? So the reality is, like we saw the other day when the unemployment rate came out and the market moved, people jumped to the idea that when the Fed cuts rates, a recession begins. And this is a mistake. Typically, when the Fed has cut rates in the last 4 cycles, it's because we had a credit crunch. There is no credit crunch unfolding, and therefore there is no real need to move aggressively in monetary policy.
Steve Risciuto of Mizuho, David Kelly of JP Morgan, thank you both. We love having you on, especially together. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. As you were discussing, U.S. inflation eased on an annual basis for the 4th consecutive month, keeping the Fed on track to lower interest rates when it meets in September. Core CPI increased 3.2% in July from a year ago. That's the slowest pace since early 2021, while the monthly reading rose 0.2%. The print showing inflation is still broadly on a downward trend alongside a softening job market. And U.S. mortgage refinancing surged last week by the most since the early days of the pandemic as borrowing costs continued drifting lower. Mortgage applications climbed 2.8%, the largest advance since the first week of June. Meanwhile, the rate on a 30-year fixed mortgage eased 1 basis point to 6.54%. And shares of Kellanova are rising in the pre-market, up 7% after Mars agreed to buy the maker of Pop-Tarts, Pringles, and Cheez-Its for nearly $36 billion. Kellanova was spun off from Kellogg last year, and since 2020, Mars, which is known for M&Ms and Skittles, has scooped up snack bar maker Kind's North America business and Nature's Bakery as part of an effort to expand its snacks portfolio. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, setting you up for the rest of the week, you're watching Bloomberg Surveillance.
Is the Vivian Tom clientele? Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world. Why do you position your products for this group of women? When I started, designing, I always want to do something that is empower women. When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example. customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, they are like in the 20s, so it's a more affordable price for them. And then, my powerful woman's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
Analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Markets still trying to figure out what to do with the CPI print. Right now, counting you down to the opening bell. Here's the trading diary for the rest of the week. Tomorrow, we'll get retail sales, plus another round of jobless claims, plus Walmart reporting before the market opens. We'll also get Fed speak, and this time, yes, it does matter, from Musalem and Harker. And on Friday, we'll get round out the week with housing starts, UMich sentiment, and more Fed speak from Chicago Fed President Austin Goolsbee. We are about 24 minutes away from the CPI print that hasn't showed that much more clarity, but at least doesn't seem to derail the Fed from cutting rates. Danny, what's your takeaway from what we saw today?
That this market was all just doved up into it, that we went so far on this bond market. The JP Morgan client survey showed the most net long on Treasuries since the start of the year. So we went into this decision kind of expecting something soft. We got something basically in line, hence the market reaction.
Anne-Marie, just taking a step back, it sort of raises this question, how much more clarity do we actually have right now versus before?
Well, when you have Steve Rasciuto and David Kelly on, I don't really walk away from this conversation with any clarity. Steve Rasciuto is talking about the fact that the Fed shouldn't be cutting. David Kelly saying they should be cutting, and he'd hope that they would go 50 basis points. If that were the case, though, think about the timeline. 50 basis points going into a U.S. presidential election where people already are trying to politicize this. So I have not a lot of clarity, except for the fact that I think, given the report here, housing costs, that's going to be a huge talking point Friday when Kamala Harris comes out.
I can imagine so. Coming up tomorrow, don't miss this, Lisa Shallot of Morgan Stanley, Tom Steyer of Galvanized Climate Solutions, Harry Sommer, CEO of Norwegian Cruise Line Holdings, and Joyce Cheng of JP Morgan. This was Bloomberg Surveillance.
Day one at the Cincinnati Open, Frances Tiafoe stormed into the second round with a straight sets win over Spain's Alejandro Davidovich Fokina. 6 aces, 4 breaks, and 18 winners for Tiafoe, while 23 unforced errors told the story of the match for the Spaniard. The American closing out the victory on his 4th match point to move on. And don't forget, you can watch all the action live on Tennis Channel. Our daily coverage starts at 11 a.m. Eastern.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
One of the institutions you've been very philanthropic with is your alma mater, Harvard. But recently, you've been very public about your criticism of the way Harvard handled the events of October 7th and their aftermath. Could you talk about that now?
The first reaction of a group of 34 Harvard student clubs on the morning after October 7th was to put out a statement saying that Israel was 100% responsible for the acts of Hamas. And my view on that was that's ridiculous. You can come out and say, look, I'm very unhappy about Israel's treatment of Palestinians in the West Bank, or you can say, we can talk about the Gaza Strip, but you can't support terrorists, and particularly terrorists that rape and pillage and murder and burn and take hostages. Well, I got actually a text from a CEO in my industry. He's like, Bill, you know the people at Harvard. I'd like to know who the students are behind these clubs, so I make sure I don't inadvertently hire them. And so I tweeted out that sort of made that point, and caused a bit of a firestorm, and I got a lot of pushback. Why are you picking on students? And I said, look, you can't hide behind a corporate entity if you're going to support terrorism.
There are many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact, a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
All right, we have markets that are showing green arrows now after CPI came in bang in line with expectations. 30 minutes until it started trading. I'm Matt Miller.
I'm Shonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, core inflation eases for a fourth month in the United States, keeping the Fed on track for a cut in September.
And we have one of the biggest deals of the year. Mars scoops up snack maker Kellanova for $36 billion.
And the push to break up Google. We've got the latest as the DOJ considers a rare antitrust move. But let's take a look at where markets are trading 30 minutes until the opening bells and 30 minutes after we got that CPI print. As Matt said, green on the screen right now. Not huge moves, especially relative to what we saw yesterday, but the S&P 500 up about 0.2% right now. Same thing, too, if you take a look at big tech. Of course, not doing too much to alter those bets on a September rate cut. Meanwhile, the bond market, you did see a move out the long end, but currently 10-year yields retracing a little bit. I'm going to go ahead and call that unchanged, Matt.
All right, I'm taking a look in depth at the CPI, at the inflation report. I'm using the function on the Bloomberg terminal, ECAN-GO, E-C-A-N-GO. If you pull that up, you can get data for CPI, PPI, non-farm payrolls, what have you. I've clicked in for a deeper look at the shelter component, which is this amber box here. You can see it's getting smaller and smaller, but maybe not quickly enough. We'll talk to Mike McKee about CPI in just a minute.
Let's look at those pre-market movers as well. We were talking about that mega deal, Mars agreeing to buy Kellanova for nearly $36 billion, and it'll bring together two major food companies in one of the biggest deals of the year. And Kellanova shares up more than 7.3% on the heels of that. We're watching shares of Starbucks after its record surge yesterday, adding more than $21 billion in market capitalization on the heels of a new CEO announced, but now down almost 1%. NVIDIA also being watched here. Shares moving about 2% higher pre-market. Remember, they've surged 17% in the past 4 sessions, adding nearly $424 billion in market value, Matt.
All right, we are looking at, I would say, kind of a muted reaction to the CPI numbers. Very important to get this look at inflation. Of course, we're also going to focus on the labor picture with unemployment claims, and then at the beginning of September, the non-farm payrolls number before the Fed makes its decision. I think when we get cooler and cooler inflation numbers, it lets the Fed worry more about the labor market. So it takes this more out of focus, in a sense.
And I mean, you made the good point that there's still a lot of data to get through before we get to that September Fed meeting. But when it comes to this market reaction, just the one-day tick, you could argue it was priced in. We got the PPI numbers yesterday. We saw that huge rally. And now we got these numbers bang in line.
How much does it take 50 basis points off the table is what I want to know, because there were still
Was it on the table at some point? I mean, all the economists that we surveyed, 80% of the economists we surveyed say 25 basis points.
Economists versus the market at all times, Matt.
All right, well, let's ask Mike McKee. He knows all the answers. He's our Bloomberg Chief International Economics and Policy Correspondent. 50 basis points?
We'll get to that in just a moment. The market is adjusting, but we did get a bang-in-line number, 0.2 on core, 0.2 on headline, and that's why you're not seeing as much of a market reaction, because that was priced. But the good news is, on a year-over-year basis, because of rounding, we dropped to 2.9% on headline. First time in the twos since post-pandemic for CPI, and headline core CPI, rather, on a year-over-year basis, 3.2%. That's a decline as well. So overall, inflation is well behaved. Now, Matt brought up ECAN at the top of the show. I want to go back into ECAN and look at where we see the big moves. And the yellow there is core services, which includes housing. And that's 90% of what happened this time. Basically, housing prices went up 0.4. That's a little bit more than last month, and that really accounted for almost all of the increase that we did see, the 0.2 increase that we did see. Now, to your question about what does the Fed do? Markets think the Fed at this point is still looking for a little more than one move, but not a whole lot. We have come off that idea, as you can see there. Number of cuts priced in under overnight index swaps, and now we're down to 1.3. We were at 1.5, and as you can see back on August 8th, and then we go back all the way to after the jobs report, and we had more than 2 priced in. So markets are backing off the idea of 2 rate cuts. But remember, we get another CPI and we get PCE before the next meeting. And the other real issue here for all of us, including the Fed, is politics. It's an election year. So what is happening with overall inflation? You take a look and you can see that inflation, the blue, is coming down on a month-over-month basis, CPI, but the level has only just sort of flattened out, maybe gone up a little bit, and you can see the red line there gives you the trend line. So voters are looking at the white and red lines, and economists and Fed officials are looking at the blue lines, and they've got to close that gap before anybody can get elected.
And what's fascinating here to me, too, is you have this inflation print this morning. This was supposed to be the big moment of the week, but there are a lot of people that are watching, and you pointed out earlier this week that tomorrow might actually be more important with the retail sales, and then many also looking at the jobless claims numbers.
If we don't get if we get a major move in retail sales, especially to the downside, then that could move markets more than we're seeing with CPI today, because it feeds into the narrative of is the economy slowing too much? Same with jobless claims, if they happen to jump up. But we probably aren't going to see a resolution to the idea of 50 basis points unless Jay Powell comes out next Friday and says not doing it, until we get the jobs report for August in September. That'll set people's expectations for what the Fed's going to do.
All right, Mike McKee, really appreciate the breakdown, as always. That, of course, is Bloomberg's Mike McKee. And let's keep this conversation going now with Amanda Agati. She is the CIO of Asset Management over at PNC. So come into this debate. 25 basis points versus 50 basis points in September. Does it really matter, the magnitude, or just the fact that we're starting?
Oh, I absolutely think that it matters, but we're very much in the camp of it being 25 basis points as opposed to 50. Of course, the market is leaning towards 50. Market wants the sugar high, craving more policy accommodation, but the sky's not falling. The market thought the sky was falling, but based on the data that's been coming in, it's hashtag choppy, but not falling precipitously here. And so we think 25 is the right first step towards easing policy.
Is that enough for us to continue this rally? I mean, we've had a great, I think the best 4 days of gains on the S&P so far this year after, I mean, speaking of choppy, last week was tough, but if we get the Fed starting to cut on September 18th, can we keep going to 56, 57, 5,800 on the S&P?
I think it's a tough slog, to be honest, in terms of keeping this rally going from here. For all intents and purposes, this market is still effectively priced to perfection, despite what happened with the sell-off and rebound. It's almost like it was a distant memory. And so there isn't a ton of headroom to keep this market rally going without seeing a really significant rebound in earnings growth expectations. And Q3 is kind of starting to look a little bit weak here. I'd like to see that rebound in terms of revisions, and so far it's going in the opposite direction. So I think that may very well be more of the key to keeping this rally going.
You know, I hate talking about the past, Amanda, but just over a week ago, we really saw a pretty significant one-day decline in all the major U.S. indices after really steep declines around the world. And you do have some fear under the surface still. Can we still see some shocks given where leverage is, given where positioning is? Do you have to be prepared?
I think you always have to be prepared. It's the things that we don't see coming, right, out of nowhere that certainly send some shockwaves through the system. I don't know that there's anything in particular at the moment that's bothersome here in terms of, you know, catalyzing a significant correction. It's really more about the fact that I think global economic growth is still quite weak. We're starting to see some movement in terms of central bank policy accommodation. Fed's last in line. It's very unusual for the Fed to be last in line. So they need to join the party here. But as long as they start moving here, I think it can help stabilize the backdrop.
And how does that filter out in terms of how you want to build a portfolio around that? I mean, I know that reading through your notes, you've been pretty defensively positioned. I mean, after we start to see that rate cutting cycle kick off in the U.S., is that the green light to maybe move out to maybe some more cyclical areas?
Oh, absolutely. I'm chomping at the bit to try and back up the truck here in small and mid and value and certainly cyclical oriented exposures. It feels a bit early, though. And so from a defensive positioning perspective, it's not like we've been sitting on the sidelines with a ton of cash. We've been fully invested, but our exposures tend to lean more quality, dividend growth oriented. There's been some minimum volatility exposure to help create some ballast in portfolios, which was really helpful in the middle of the sell-off, and we're leaning investment grade and fixed income. So I would like to move towards cyclicals. I would like to move towards some more below investment grade credit exposure, but just not yet. It's a little bit early to make that move.
Are you worried about the consumer, Amanda? We've gotten some I guess, concerning reports in terms of big ticket items like travel from TripAdvisor, Airbnb. We've gotten, not encouraging reports from Disney in terms of the parks, and we get some retail numbers out this week. How's the consumer look to you?
The consumer is starting to exhaust itself. It is not hitting a wall per se, which is good news, but I think the consumer is definitely starting to exhaust itself. And so there's still a lot of activity happening on the services side of the equation. You see that in the CPI print for sure, but definitely there's some trading down in terms of behavior that's happening there. It's natural. It's late innings of the cycle. We've been spending like gangbusters these last few years post-pandemic. So I think it's natural to see that start to fade a bit here. I think back to school shopping is going to be really interesting to see what happens from a consumer spending perspective. Certainly holiday shopping. I can't believe I'm saying that since it's August, but I think we're going to get some more clarity on health of the consumer going forward, but we don't see this big wall right in front of the consumer here.
Some of these big consumer names are really driven on some significant and event-driven activity. You look at Starbucks, you look at Kellanova today, and there's a sense out there that this is a stock picker's market. Do you buy into some of these moments that M&A or spin-offs or other event-driven moves are giving investors a new opportunity?
I always feel like it should be a stock picker's market. As a former equity analyst, I'm all in on the idea of stock picking. And so certainly event-driven opportunities can create some interesting actionable moves for investors. It has not been much of a stock picker's market this year. It's really been the top 5 or 7 names that have been the only things that matter. And so active management has definitely struggled. But I do think that as we move towards Fed policy accommodation, an inflection point in the cycle here, it is going to create some more opportunities for investors to get really active and be less focused on just broad beta exposure. As it relates to some of the deals and what's been going on today in particular, that to me feels like a pricing power story. So to kind of harken back to consumer starting to exhaust itself, I think some of the catalysts for some of the deals and the action that you're seeing is because pricing power is starting to wane. And so scale in this environment is going to matter an awful lot going forward.
All right, Amanda Gotti cut her teeth at Legg Mason. Now she's the CIO at PNC's asset management arm. Thanks so much for joining us. Great to get your take. Another quick check on futures after that CPI number. We're still looking at green arrows here, just about 1 or 2/10% on the S&P, and on the Qs, you see Russell 2000 up about 1/3 of 1%. So we're looking at gains even as bond yields rise a little bit, 3 or 4 basis points. Let's get a look at these individual stocks moving ahead of the opening bell. For that, we go over to Bloomberg's Jess Menton. Jess?
Well, happy CPI day, guys. The option market was pricing in a 1% move in either direction, but as you said, Matt, the futures kind of muted reaction right now. But when you look under the hood here, Micron Technology, one of the big movers this morning, if you look at that stock, up about 3%. So New Street Research actually reiterated a buy rating with $150 price target on this. Stock's actually up over 50% over the past 12 months, so outperforming its other components here. But really, this had to do with a lot of the AI and server type business. If you move over, though, look at some other individual movers, though. Have to point out Alphabet's Google getting pressured here, down about 1% in head of the opening bell here. A lot of this had to do, as y'all were mentioning earlier, when it comes to the Department of Justice potentially having any potential thing when it comes to breaking up the company, when it comes to its online search engine. Of course, this tried to do this a couple decades ago with Microsoft. Didn't work as well there, so it's probably why you don't see the stock moving even lower on this, but Alphabet stock's actually up about 18% year to date. And then moving over and looking at what's happening in the healthcare space for healthcare distributors, Cardinal Health here getting a bit of a pop here, up almost 6% ahead of the opening bell. If you look at its annual profit forecast, actually boosting that. But something to keep a close eye on is if it gaps up above its 200-day moving average. If you look at the A&R function right now, has 9 holds, 9 buys, and actually 1 sell rating on this. But those are some of the big movers ahead of the opening bell, guys.
Jess, we thank you so much. I know we'll talk to you later in the show. Looking forward to it. And coming up, we're going to talk about a major deal. Candy giant Mars is forking over $36 billion to buy Eggo and Pringles maker Kellanova. We're going to discuss the consolidation we're seeing in the food industry. Up next, Kellanova shares on the rise. This is Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Let's get now to high interest to look at what's making headlines around the world. The world's biggest steel producer is sounding the alarm about a crisis in China with the potential to send shockwaves across the globe. The chairman of Baowu warned of a deeper industry downturn for the metal than the traumas seen in 2008, I should say, and 2015, with conditions in China proving to be, quote, longer, colder, and more difficult than expected. UBS, on the other hand, beat expectations in the second quarter after posting higher than expected profit thanks to investment banking revenue. The Swiss bank has also made progress in its integration of Credit Suisse, and CEO Sergio Armati doubled down on efforts to return capital to shareholders through a $1 billion share buyback this year. Victoria's Secret is poaching the top executive from Rihanna's lingerie brand to lead its turnaround. Hillary Super is replacing Martin Waters as CEO at the retailer, with CFO Tim Johnson assuming the role in the interim until September 9th. The lingerie maker has been struggling for years with competition and misconduct allegations. Shonali?
And we're keeping an eye on shares of Kellanova. We've been talking about it, one of the largest deals of the year. Mars is buying the maker of Pringles chips and Eggo waffles for $36 billion. Buying Kellanova will help diversify Mars's chocolatey product line away from cocoa, which has hit historically high prices this year. Mars has been diversifying into the snack business, and earlier this month, Kellanova actually raised its guidance for the full year. Let's discuss what's going on with Bloomberg Deals reporter Crystal C., who, of course, has been covering this story, but also realizing Kellanova actually recently spun out of Kellogg's, now merging with Mars. How is this a company that has changed hands like this? What does this make sense most in this industry for?
Yeah, so Kellanova is actually the RemainCo, and KW Kellogg is the spinoff. Anytime you have like a spinoff situation or any kind of a separation, actually both companies tend to become more vulnerable, even though this is a really big company. It's like a $30 billion company. Today, the premium is sitting at around 33% compared to the unaffected stock price 2 Fridays ago. I think it's really interesting because the tax, there was a tax implication when it comes to any spinoff, and that has reached its sunset. So it's a really good time for any buyer to come because the separation is done, the tax is out of the way, and there you go. This is a deal.
I feel like hanging over the M&A space, of course, is regulation concerns, antitrust concerns. What are we expecting when it comes to this deal, which has a pretty huge price tag? I believe this is the largest deal of the year.
It's the largest deal of the year so far. It's larger than the Capital One situation. So right now, it is the top of the M&A league table. So congrats to all the banks and advisors that are on it. But like Shonali was saying, actually, Mars has a lot of cocoa products. So it's mainly sugar, sweet confectionery products, whereas a lot of the Kellanova offerings tend to be savory snacks like Cheez-It, Pringles. So actually, all in all, it's actually quite a good combination. It's quite a complementary portfolio of products.
They also make Pop-Tarts, which is, I think, interesting because it comes after what is possibly the worst movie ever made.
Jerry Seinfeld. I love that movie. I don't
You
know
thought it was good?
Yeah, I loved it. Kitschy,
What movie
love
is
it.
this?
The Pop-Tart movie.
Oh, I didn't know.
You didn't see it? Well, all right. I only saw a little bit. I couldn't get through the whole thing. But they get an international reach with this as well, right? Because Mars has been fairly restricted to U.S. sales.
So actually, Mars has some European operations as well. Mars actually has a pretty good global footprint. And when this when this deal was kind of became on the blog, when it became separate, it kind of put a sale flag on the company. One of the concerns is that if there's a U.S. buyer that approached Kellanova, it doesn't have the distribution or the expertise to sell the products globally like Kellanova does. Actually, Mars comes in being one of the most perfect natural buyer here because they actually know how to sell your Mars bar, your Twix, outside of the U.S.
Just wanting to comment here on Crystal's point here on the bankers here, because it did pop Goldman on the league tables, even higher up on the league tables, now firmly in the lead for M&A above JP Morgan from a 26% market share compared with JP Morgan's 23%. Lazard, also on the deal, came in with record revenue in the most recent quarter. So solid inking here of the deal's turnaround.
Well, like Crystal said, congratulations to the bankers. Crystal C, thank you so much. Appreciate your reporting this week. Now, coming up, we'll take a look at the companies making the most social buzz today in our Social Climber segment up next. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, it's time now for Social Climbers, the companies making waves this morning. And first up, Brinker International, the parent company of Chili's Bar and Grill and Maggiano's Little Italy, missing profit expectations and giving a downbeat outlook for the next year. The casual dining space, of course, has been hit by a decline in demand from cash-strapped patrons, and you're absolutely seeing that in shares today. Next up, FanDuel parent Flutter Entertainment reporting soaring sales in the second quarter. Remember, the company recently moved its stock listing to the NYSE from London and as such, benefiting from a surge in new U.S. customers. And finally, Donald Trump's appearance on X earlier this week, creating yet another headwind for his own competing social media platform. We're talking, of course, about Trump Media and Technology. Of course, this is the latest blow that's wiped out $3 billion in market value from the stock just in the last month. DJT, of course, struggling with mounting losses and stagnant user numbers. Of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal, Matt.
All right, let's get a quick check at what's going on in terms of the stock market futures. We're looking at gains of about 0.2% on S&P and NASDAQ futures. Don't forget, yesterday we had a massive rally. The NASDAQ was up, I think, 2.5% yesterday, and it's been the longest or the best 4-day stretch for the S&P. Here you can see the 2-year yield as well. Me and Shanali keeping a very close eye on 2-year yields. Up almost 5 basis points, although we did see a little bit of a dip into the number. The CPI number looked to relieve some market participants in terms of the coming cut. This is Bloomberg.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, you know, with lots of supporters, a really mind-blowing level of innovation against emissions. And you know, in the last 9 years, that's gone better than I would have expected. So only now could you even, you know, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up very like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
All right, we got about 20 seconds until the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We are seeing green arrows here on futures right now. So S&P futures up 0.1%. Don't forget, this comes on the heels of a massive rally yesterday. NASDAQ was up 2.5%. Now you see futures up about 0.2%. Opening bell ringing at the New York Stock Exchange. Realty Income celebrating its 30th anniversary of its listing. And you got blacks at Microsoft looking to advance people of color within the company, recruit talent, retain talent, ringing the bell over at the NASDAQ. In terms of where the indexes are trading, just a few seconds into the start of the cash trade, let's get over to Katie Greifeld. She's got the details. Katie?
All right, 22 seconds into the U.S. trading day. As you said, it's a little bit quieter than what we were looking at yesterday. Of course, that massive rally following softer than expected PPI. Yesterday, we got bang in line CPI at 8:30 today, so not too much of a reaction right now, but you can see the S&P 500 up by about 0.2%, a little bit more so if you take a look at big tech, up about 0.3%. Small caps in the lead right now, at least for right now. The Russell 2000 up about 0.4%. Let's take a look, though, at Victoria's Secret. Shares absolutely climbing right now on news that it hired the top executive from Rihanna's lingerie brand. Hillary Super will lead the turnaround plan for Victoria's Secret, which of course has struggled for years with added competition and a slowdown in demand. Super begins the new position next month, but of course traders not waiting. Shares currently up about 16%, Shanali.
Keeping an eye still here on Kellanova shares, up more than 7.3% this morning on the year's biggest deal. It's been talked about for some time, but this morning Mars said it would agree to buy Kellanova for $36 billion, and here's the catch, in cash. And Kellanova makes, of course, snacks like Pringles, Eggo's waffles. Analysts have said a Mars Kellanova tie-up wouldn't face major antitrust concerns, so the ARBs here have no reason to be all that concerned, if you listen to the analysts at least. Matt?
I feel like you're intentionally leaving out Pop-Tarts. Do you not like Pop-Tarts?
I don't. I'm more of a toaster strudel kind of girl myself.
All right, Shanali, thanks very much. Alphabet's Google. Bloomberg was the first to report that the U.S. Justice Department may soon attempt to break up Google after a landmark court ruling found the obvious. The company monopolized the online search market, as we all knew already. Let's discuss with Bloomberg Technology co-host Ed Ludlow out of San Francisco. And Ed, it's not, I guess, so important that they monopolize search or that they have a monopoly there. It's what they do with it, right? That's the problem.
Yeah, I think what we're learning through this reporting is that DOJ officials are looking at the entity as a whole, Alphabet, parent of Google, and saying, what action can we pursue? So the headline is that those DOJ officials and attorneys are considering a breakup bid, but there are many other options on the table. For what it's worth, Alphabet is down more modestly than it was in after hours when this story broke. I think we're down 0.8%, but so are some of the other mega caps. It's interesting in particular the divestment of the Android operating system. So we know that the concern about Google is that when it negotiates with a device maker, it contractually requires them to have preferable placement of, say, the Chrome application or Gmail application on a phone that has Android OS. So what about divesting Android OS? The other battleground is data. Either that Google is precluded from accessing data of the websites that it has access to through search, or its competitors get access to its data. So read the story. There's a number of options on the table here. A very thin sell-side reaction, and so it's hard to gauge the concern.
Yeah, well, that's what I wanted to go to, and I'm glad you brought up the pretty muted reaction right now. I mean, Alphabet shares currently down about, 0.7%? I mean, what to make of that? That the concern here isn't that great, that basically traders aren't seeing this as a very serious possibility?
What's that great Bloomberg expression at the moment? Context changes everything. Washington hasn't tried to do this for 20 years when it looked at Microsoft and wasn't really able to take that action. And so that's why the detail of the story is important. You know, a breakup bid of this size, factor in the political will needed to do it, the potential change of White House in November, particular focus on J.D. Vance, and the continuity of policy around antitrust. But it's just really difficult to do because how ingrained search and Android OS is in devices and people's habits around the world. But the sell side is sanguine. I think I've seen one note from Dan Ives who's kind of shrugged it off. He's pretty bullish on tech, generally speaking. Right, so let's see how they act.
Yeah, and obviously after September, there's going to be a lot of discussion that will re-amp up about this exact matter. Bloomberg's Ed Ludlow, we thank you so very much. We know we're going to cover it much more on Bloomberg Technology at 11 o'clock. We're going to broaden out the conversation now about the markets with Lazard Chief Market Strategist Ron Temple, because, of course, elsewhere, in addition to all of this news about big tech and about deals, we also had CPI this morning. The data has still been driving the narrative. We have retail sales tomorrow. We have jobless claims. So you take it all together, and where are you still looking for the most clues on the path forward to that next rate cut?
Well, I think the evidence is definitely in that inflation is largely back under control. If you look at the CPI over the last 3 months, at a headline level, it's annualizing at 0.4%. On a core basis, 1.6%. Again, 3 months is kind of short. But if we extrapolate back, you see a clear trend lower in inflation. And then the big debate is this because the economy is weakening too rapidly? You just mentioned retail sales tomorrow. On Friday, we'll get the preliminary Michigan sentiment, although that one's a little questionable because it tends to inversely relate purely to inflation.
And then really the next data points are early September when we get the jobs data and JOLTS. So I think the evidence to me is the economy is still strong, inflation is decelerating, and full steam ahead for the first rate cut on September 18th. But I don't think anyone should hold their breath for 50 basis points.
As the consumer weakens, do you consider that gradual? I mean, they're not buying the big ticket items, not making holiday bookings. I even have been reading Bloomberg Intelligence research that marijuana buyers are looking for smaller ticket purchases. They're going down market a little bit. So clearly, wallets are tight.
Because those were really the big spenders, Matt.
No. The point is, I mean,
that might go back to your Pop-Tart conversation.
Right.
Yeah. Anyway, I don't think we should extrapolate from cannabis, but I do think there are signs of the consumer basically seeing more fragility. I was encouraged last week. The New York Fed put out their quarterly household debt survey. The prior quarter, I was pretty worried because we saw significant increases in 90-plus day delinquencies on mortgages, on auto loans, credit cards. This quarter, it was stable. So 1.83% serious delinquencies, same as last quarter. Consumer debt went up very little in the quarter. So this says to me, yes, there are again signs of some moderation. And I'm always careful to say, by the way, let's remember, the economy started from a very strong position. So it's a deceleration of a strong economy. It's not a weak economy.
And I mean, if you take a look at the sector level, I mean, I hear what you're saying, and we're talking about the weakening consumer. And I mean, for some people, that would scream staples. I mean, invest in the companies where people need to spend money. But then you take a look at the sector level going back a month, 3 months, year to date, and that's kind of been mid-pack. It really feels like it's just been tech that's dominated up until, what, the past month or so. I mean, how do you put that together into a portfolio view?
Yeah, so I think what's really been interesting, again, is every day I tend to look and say, okay, what percentage of the year-to-date gain has been the top 10 stocks, top 20? It's still nearly 70% 10 stocks year-to-date. It's 80% from the top 20. But what's really interesting, if you look at the earnings trajectory and what the market is expecting as we move toward year end, is the gap between the big 6 tech companies and the rest of the market narrows substantially. So I believe this quarter, if you look at the top 6 companies, it's around 38% year-on-year earnings growth. Rest of the market, 3%. And so by the time you get to the fourth quarter, those numbers go to 18 and 9. So I think that's what's going to be interesting is this broadening out within the market, not necessarily to staples. It might not exclude staples, but I think you're going to see more beneficiaries of this spending on tech as we move into next year. We're also going to see the beneficiaries of lower interest rates. I mean, if you think about it, small cap stocks are one of the biggest beneficiaries. The Russell 2000 has twice the debt to cap of the S&P 500, and 45% of that debt is floating rate versus only 10% for the S&P 500. So I think you're going to see some benefits there, and actually might be one of the better opportunities in the market right now.
One of the moves this morning that I was most interested in was the way the yield curve moved. There was a further steepening of the yield curve, and I've got to say, this week a lot of investors aren't watching CPI as much as maybe they're watching jobless claims, which in a prior world, that wasn't the case very recently. Are you worried about a landing that could be a little harder than what most people are prepared for right now?
I mean, we always have to contemplate the range of outcomes that could occur, but I'm quite confident that we are not going to have a hard landing. Again, this is an economy decelerating from strength to less strength, but I look at the yield curve right now, a 10-year yield at 385 this morning. To me, that's too low. I think the 10-year yield should probably be between 4 and 4.5%. And so that steepening makes sense. I think you're going to get the short end of the curve is going to come down. I think the market, by the way, is expecting too much at that end of the curve. And I think the market is pricing in too much in terms of how low Fed funds will go in the easing cycle. So if you look at Fed funds futures, use WIRP on your Bloomberg terminal, you can see by July of next year, the markets are saying 200 basis points of rate cuts. I don't see that. And I don't see 100 basis points by year end. I think basically the market's overreacting to 1 month of bad data from the jobs report.
And of course, that steepening trade has been breaking hearts for like a year. I feel like people have been trying to make it work to little success. But Ron, we're just getting started. You're sticking with us. That, of course, is Lazard Chief Market Strategist Ron Temple. Meanwhile, let's take a check on these markets. Of course, a couple minutes into the cash trade, you can see the S&P 500. Small gains. We're talking about 0.1% after that inline CPI print. Of course, all the big moves were yesterday after PPI. We're going to continue to keep an eye on markets next. This is Bloomberg.
Stories that move markets are on Bloomberg.
Our role in the world, our role in NATO in supporting the Ukrainians in this war, the unprovoked war that Russia has instigated in Ukraine, our support for the Indo-Pacific, for providing a counterbalance to China. All of that is in our interest, and whoever's president, I'm sure, is going to do what's in the best interest of the United States.
It is not a time for America to back off of its commitment around the globe. And I think there's a justification for us making certain that we do the right things in a way that we share the burdens with our allies. But I don't expect America to walk away from the world in any administration. It's about American security, and it's about making certain our adversaries, present and future, know that when America's committed to something, they're there for the long haul.
Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Deutsche Bank says that Starbucks is now a buy, thanks to news, of course, that the coffee chain has tapped Chipotle CEO Brian Nichols to take the reins. Deutsche Bank says that this is a home run hire for Starbucks. Deutsche Bank's just one of the handful of banks upgrading the stock in the wake of that announcement. Next up, Argus Research says stop buying Hershey. The maker of Reese's Pieces slashing sales and earnings outlook for the year as shoppers really cut back on purchases of higher-priced chocolates and candies. Goldman rating the company a sell earlier this week as well. And finally, Cantor Fitzgerald telling investors to turn up the sound on SoundHound, recommending the stock as a buy and raising its price target. The company, of course, announced robust second quarter results along with the acquisition of an AI software company. The analyst over at Cantor says that the deal could be, quote, transformative, Matt.
All right, interesting stuff. We are back now with Lazard, Chief Market Strategist Ron Temple, and I wonder what your take is on stocks. You know, it seems like everything we were freaked out about the last few weeks has passed us, right? The carry trade has been largely unwound, or maybe doesn't matter as much as we thought. The earnings are really solid. Inflation is coming down. The Fed looks like it's on track for one rate cut, but not, you know, an emergency rate cut of 75 basis points. Can we head back to 56, 57, 5,800 on the S&P at year end?
I think we can. I'm optimistic on the market more broadly. I do think, again, the dynamics are going to shift within the market away from being largely driven by 6 stocks to a broader base as earnings accelerate for the rest of the market. But, you know, I don't want to go too far in terms of valuation. S&P 500's at 21.7 times forward earnings as we speak. That's not cheap.
Is it priced to perfection? I mean, do we risk a drop if we disappoint on earnings?
No, I think there definitely is risk in certain individual stocks, as there always is. But when I look at equal weighted S&P, it's materially cheaper. If I look at other indices outside of the U.S., I think there's some real opportunities there. So I'm optimistic we still have upside, again, based largely on my scenario, the base case scenario of no recession, easing of interest rates. Importantly, when the Fed does ease, I don't think we're going to get 200 basis points of easing. You know, that would be the maximum I think we get out of the Fed. So maybe discount rates are a bit of an issue. Maybe we get 100 to 150 basis points of easing in the next year. So a little less optimistic on the Fed front, but that's because I think they're easing because of lower inflation, not economic weakness.
I also think one really important aspect of this is that inflation isn't a monolith. And if you looked at the data this morning, it was housing, it was insurance, it was kind of these important areas that people really need that would potentially, and this is according to Bloomberg Intelligence's Stuart Paul, crowd out the discretionary spending that you would see from the consumer. How much do you buy that theory and start to worry about stagflation under the surface?
Well, I'm glad you brought this up because when you look at the moving parts, all of the inflation this month, so core inflation 16.5 basis points, 23 of that was housing, right? So core goods went further into deflation. So it's really interesting. If you go back through the history of this inflation cycle globally, it really is largely a story of the pandemic, right? We had the surge in demand for goods. At the same time, you had supply shortfalls because of semiconductor shortages, shipping disruptions, et cetera. You had a big increase in goods prices. That's unwinding now. And so what's really driving inflation is housing and, frankly, auto insurance. If you look at auto insurance prices up 18.5% year over year in July, that contributed over 4 basis points of the 16 basis points, of course.
Mine is off the hook. I mean, it's like ridiculous.
It is consistent. By the way, the range of factors, if, you know, minor repairs that used to cost you $100, there's so many electronics embedded in cars now. You know, getting a new mirror on the side door could cost you $800 to $1,000 because their camera in the mirror is so expensive. And so there's partly that, but then there's also this concept of social inflation, which if you want to nerd out with some insurance analysts, go for it. But bottom line is there's more litigation, and juries are seeming to be more sympathetic to the litigants.
This is so my home turf, Ron, I've got to say. This is the nerd in me.
How's your auto insurance? You just got into a new car.
Not great.
No.
But that's got a long history to it.
All right, let's go back to earnings because we are in earnings season, and I don't know, you think about expectations, especially, you know, you think about the broadening out that everyone told us was going to happen in earnings. Hasn't necessarily happened, and it feels like just overall this has kind of been a mediocre reporting season. And I mean, you translate that into what we're seeing in the macroeconomic picture with expected Fed rate cuts beginning in September. I mean, what does that translate to going forward through the end of the year?
I mean, you're right that it's been mediocre relative to the last 2 quarters. We had bigger beats on average relative to expectations. But let's just keep in mind, earnings this quarter are still likely to grow 11% on 5% revenue growth. That's good. I mean, on average over time, I think we should be expecting more like 8 to 9% earnings growth out of the S&P 500. So again, not so bad. The composition is the bigger issue that we've already talked about. And again, that's where I get optimistic about the ability of the market to rally from here, is when you have more companies delivering better earnings growth, that should lead to a healthier market. It's really interesting, by the way, back to the 80% of the rally year to date from 20 stocks. If you look in European markets and other non-US markets, it's a much healthier rally that we've seen. You know, for example, looking in Europe, you've got banks, you've got tech, you've got healthcare. In the US, it's tech, right?
Yeah.
And so I'm looking forward to seeing that transition as we move toward year end, and I think that's a positive sign for the market in general. And I don't want to miss this, by the way. I do think people should look beyond the U.S. because the big sell-off in the last 2 weeks, you know, Japan is the glaring sell-off. And a lot of the clients I talk to have been saying for the last year, every strategist is telling me own Japan, but when you ask them, well, do you own Japan? The answer is no. Well, if you've been waiting for your opportunity, now's a good time to do your homework on Japan as well.
Ron, great having you in. I'm going to try and get you back in here when we get the non-farm payrolls number, or before the Fed, let's say, in September. Ron Temple, their chief market strategist from Lazard. Coming up, some investors say credit investors should be listening more closely to what the VIX is saying. We'll explore in our Wall Street Beat next. This is Bloomberg.
your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The bond market is definitely pricing a higher risk of a hard landing. I mean, that's what the yield curve's telling you. That's what the 2-year yield versus the Fed funds is telling you. As an equity person, you should pay attention. I mean, the bond market has probably a better look at, okay, what is the risk here? The bond market's not saying recession, to be clear. It's saying the risk of a recession has gone up in the last 2 months, which makes sense.
That was Mike Wilson, Morgan Stanley chief U.S. equity strategist, joining us yesterday on a hard landing signal that might be coming out of the bond market. And for today's Wall Street Beat, we're taking a look at what bonds and equities are saying about the likelihood of a U.S. recession. Here to help us more is Bloomberg's Olivia Raimonde, who wrote this story, and it was interesting. Just a day ago, we were talking about Boaz Weinstein and his campaign against closed-end funds, but really he benefits in times like this, of volatile times, volatile stock and bond markets. What is he saying? What are other people saying about the mixed signals here being seen between the credit spreads and where they are right now and what the VIX has been doing?
Yeah, absolutely. Boaz put out a really interesting tweet last week during the market volatility that showed the correlation between VIX moves and moves in credit spreads. And essentially, he said that we've never seen a VIX this high and credit spreads widen out so little. So he said one or both must be wrong. The question is, what's the answer to that? And Boaz says that credit spreads are underpricing in the risk of a recession. We've seen weak labor data, weak housing data, weak manufacturing data. And yes, spreads widened out last week, but not nearly as much as the VIX did. And now they've come back down, and some investors say that spreads will widen again, but there are others that are firmly in the soft landing camp.
I mean, I thought that was an interesting tweet as well, because how much can you trust the VIX? I mean, I know we got to, what, 40 on the VIX last
64.
week?
65 almost,
well, intraday, I'm just looking at, the closing. I guess that doesn't quite matter. But now we're back at 17. The point being, we went up and now we're down. So, I mean, is the VIX the true signal here, or is it credit spreads?
Well, to be clear, they both went up and they both went back down. So it was, the magnitude of the move. I think what Boaz and TCW as well is trying to say is that even though the VIX probably overshot, and there was a lot of technical factors that had to play into there, the move itself still reflected real concern about the recession going forward, whereas the widening that we saw in credit spreads and just where we see them sit now and even last week compared to historical averages is way too low and not pricing in nearly as much recession risk as Boaz and TCW and other funds think should be priced in.
All right, Olivia, great story. Thanks so much for joining us. We're going to keep an eye on both of those things, the VIX and credit spreads. I want to get to the trading diary right now, what you need to be watching for the rest of the week. Tomorrow, we get retail sales data, plus, of course, we get earnings from Walmart tomorrow, as well as Deere. On Friday, U.S. housing starts are released, and the University of Michigan consumer sentiment data, although Ron Temple doubts the importance of that. We're also going to hear from Chicago Fed President Austin Goolsbee this afternoon. You've had some Fed speakers pushing back against the necessity of a rate cut in September. This is Bloomberg.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google public, so I had a little sneak preview.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast. That's where you'll find all of the audio and video here. Coming up, we're going to check in on the markets with Nora Melinda. She's in studio. Emily Rowland, Co-Chief Investment Strategist for John Hancock Investment Management up there in Boston. Get her thoughts on this inflation print and what we might hear from the Federal Reserve. Brent Schutte, CIO at Northwestern Mutual Wealth Management Company, one of the smarter voices I think we get to chat with. He generally has a conservative view of the market. We'll see if that's still the case here. Allison Williams, Bloomberg Intelligence Senior Banks Analyst. We're going to break down some of the big banks. UBS came out with some numbers, so some of the European banks are starting to report. We'll get the latest there. Let's kick everything off on this Wednesday morning like we do with Mr. John Zucker.
All right, Paul and Alex, we're being brought to you by IBKR Financial Advisors. Switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest at ibkr.com/RIA. Nothing really rocking the boat here. The core consumer price index increasing 3.2% in July from a year ago, the slowest pace since early 2021. So kind of seals the deal for a September rate cut from the Federal Reserve. And economist Neil Dutta at Renaissance Macro reacted to this morning's consumer price index. And this is what he had to say. Neil? All right, maybe
we know that inflation is a lagging indicator. So whatever inflation is at the moment, that represents yesterday's monetary policy. So if inflation has already been slowing, I think, just based on inertia, there's probably more room for it to keep moderating. And so I think the Fed needs to kind of get going here.
The two-year yield right now, 393, pretty much unchanged. 10-year down 2 basis points. That is at 381. Best performing stock right now in the S&P 500, Kellanova, up 7.3%. I'll just do a visual. This is all you have to know.
It was Cheez-Its. It's Cheez-Its for those of you on radio.
It's a marriage kind of made in snack food heaven. So Kellanova and Mars.
Chocolate-covered Cheez-Its.
Price tag there, $36 billion. A lot of Mars bars that will buy you. As we look at the S&P 500, we have 6 of the 11 major industry groups. They are higher right now, being led by financials. S&P 500, 5 points lower. That's down 0.1%, 54 at 29 in the index. The Dow Jones Industrial Average up 44 points. That's a rise of 0.1%. And the Nasdaq 100 right now, 63 points lower. That is down 0.3%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. I never really got into Pringles.
You didn't like Pringles? What? How do you
Never
not?
got into it.
How do you actively not like Pringles?
I'll be there right next to you, John.
Like, I know being like,
Thank
it's
you.
not my thing, but all right.
Nope.
I'm Alex Steele, alongside John Tucker and Paul Sweeney. Norma Linda is here as well. So listen, we're going to have a great 2 hours lined up for you. This is going to be an amazing 2-hour show, and also nothing is happening.
No, well, we've got a big M&A trade.
Yeah, but we already knew that was coming, so it's sort of,
It wasn't a surprise.
It wasn't a surprise. We already had the big market move. Volume is super light. Nothing's
down
going
to the
on.
advisor section because I'm saying, how is Mars, a private company, going to fund this? Well, it looks like they're getting some bank funding from J.P. Morgan and Citi, and so that's pretty good. They're
So
big
there's
banks, they
that.
have big balance sheets.
That was my way of saying that the CPI was a big nothing burger.
Right.
Big old
You're exactly right.
nothing burger. All right. Norma Linda is joining us, though. She is going to give you some amazing individual company moves, starting with Kellanova.
Yes, let's talk about Kellanova because, of course, I'm always thinking about food. And this is a great marriage, as you said, John, earlier. So Mars has agreed to buy Kellanova for nearly $36 billion. That also includes debt. And the kicker here is that it's a cash deal. So really interesting to point out there. And the price represents a premium of 33% over Kellanova's closing price on August 2nd. We know that Mars is, of course, a candy maker, and it's really been trying to diversify its products away from the chocolate-heavy portfolio that it's had, especially with cocoa prices rising to historic levels this year. So this should allow it an opportunity to really branch out into new things, especially since Kellanova is known for Pringles, Eggo waffles, and I want to say Pop-Tarts.
Yes.
Oh, yeah. Were you all ever Pop-Tarts people? Or is...
So my 2 years of Duke Business School were fueled by Pop-Tarts.
This is business school.
And pizza, yes. That's basically how I got through.
He was very
Oh
slim
my gosh.
during business school.
Yeah, during those years. I'm looking at this transaction. Again, this Mars company fascinates me because it's private. You don't know a lot about it. And at Duke Business School, we had one of the Mars family members come down and speak to us. Really interesting history. They're going to fully finance the acquisition through a combination of cash on hand and new debt for which commitments have been secured. Good for them.
Yeah, they got it done. All right, Victoria's Secret also trying to get it done.
Yes, switching over to Victoria's Secret, we are also seeing this stock up. It's jumping as much as 22%. This is the biggest intraday level that it's had since August of 2021. And this is coming off of news that it has snatched Hillary Spur from Rihanna's thriving Savage X Fenty empire, and she'll be replacing Martin Walters, who was terminated as CEO and also resigned from the board. She'll be replacing him as CEO and a member of the board, the company has now announced. And of course, we know that Victoria's Secret has really been struggling. As I'm looking at the stock, it's down about 17% year to date, and it's really been struggling to reach customers due to waning demand. But I mean, I do know, at least, like, I'm pretty sure my demographic is pretty closely tied to Rihanna's brand. So I know a lot of people that buy Savage X Fenty, and it's been really successful. So I'm really interested to see how this goes moving forward with Hillary.
So Victoria's Secret's not a thing anymore?
No, definitely not a thing.
When did that happen?
A few years ago.
I was gonna say.
It was around the pandemic also. Like, it just wasn't what women wanted to buy and wear, and they just missed the boat.
They did.
And then now trying to transform it
who's
while
the new
still keeping
Victoria's
your
Secret?
band is really hard.
Who's the new, who replaced Victoria's
I feel like it depends on who you ask. I know
don't-
some people like Aerie. I think, is it Aeropostale that has that brand?
Yeah, but also I don't think that there is one. I think that's kind of the point. Like, it's like women want comfort and cute, not like really uncomfortable lace things with
Welcome
straps
to
and stuff.
Lingerie Talk with Paul.
But tell me more about Savage X Fenty.
Yes, I mean, so it was pretty much one of her initial brands. I mean, of course, she also has Fenty products, her makeup skincare line that she also has. But Savage X Fenty has been the lingerie brand that she really brought out. And it's been at the forefront of a lot of younger consumers that are constantly buying it. I know I hit it up for Black Friday. They do have some sort of subscription-based program that a lot of people will opt into, and that should allow you cheaper prices outside of the subscription. Not that convenient, pretty expensive, but
okay. So it's not just about the clothes. It's like how they did the business model and all that kind of
business
stuff.
model, and it's Rihanna. Who doesn't want to buy from Rihanna?
That's a fair point. Skims.
Yeah, I know.
Skims, right?
No, Skims. Like, that's a good place.
Kim
right?
Kardashian.
Kim Kardashian's line. Like, I appreciate you don't want to
one.
buy from Kim Kardashian, but it's actually like a really good,
thriving brand.
Yeah, doing really well.
All right, John, go check that out.
This is a fun conversation. So let's go to Brinker International.
Yes. Once again, food. I love to think about it. So Brinker International, they're the owner of Chili's and Maggiano's Little Italy. I've never been to Chili's, actually, but I love Maggiano's. Brinker International is seeing its worst day since 2022. We have shares tumbling as much as 16%. Now, this is after it reported a weak profit view, and it's dimming its sales beat. That's overshadowing the sales beat that it had because people are really focused on the outlook. And actually, Citi's analyst said that this earnings report leaves something to be desired by investors. So not the best read-through that we're seeing here.
This is it's another read on the consumer. I mean, we're going to get those retail sales, Manana, but we had Tony Capuano, the CEO of Marriott, in earlier, and they're not in the budget part of the hotel brand, but he says that's where the weakness is there, as opposed to some of the Marriott brands. But we're seeing it here in the restaurant business as well.
Right. And this is a fun ticker, EAT.
Yes.
EAT.
Yep.
I'm looking up Savage X Fenty. So sorry, what were we
we're
talking
good.
about?
No, we're just talking about Chili's and Brinkers. So.
Cool. All right, Nora, thanks a lot. We appreciate Norma Linda joining us, Bloomberg Equities reporter, joining us there. All right, let's get a broader take here on the markets. Like I mentioned, it was a nothing burger, the CPI, but we could also make an argument that we've already had a humongous move over the last couple weeks. Volume's also light, so you're kind of in a different positioning stage. Emily Rowland is co-chief investment strategist for John Hancock Investment Management, joining us now. Hey, Emily, what do you make of the non-reaction in the market? Like, what does that tell you about positioning and sentiment?
Well, it tells us that the PPI report yesterday really sort of stole the show, coming in lighter than estimates. And you saw big moves in bond markets as well as across equity markets. So I think today, coming in right around in line with expectations. Of course, that sticky shelter or housing component still looking like the primary driver of inflation. And, we're seeing the housing data take a long time to slow down. Inventories are still really low. Prices are still elevated. So we think that inflation is certainly coming down. That's great news for markets, but it's not happening in a straight line.
Exactly. So what does that mean for our Federal Reserve here? I mean, it feels like this is kind of giving them some runway. I know we have some more economic data between now and September, but boy, it seems like they could certainly go here.
Yeah, this certainly gives the Fed the green light to go in September, which of course the bond market was already pricing in. The expectations shifted a little bit after the report. We went from 50 basis points being kind of the slight odds, and now it's back to 25 basis points, which feels about right for us. Again, the Fed has noted that the labor market is seeing some cracks. They're confident that inflation's decelerating. And I think they certainly want to cut rates, and that's our expectation going into September. There's still some more data, though. We're going to get another jobs report, another CPI report, and of course, we have Jackson Hole at the end of the month. So I think kind of hemming and hawing about 50 versus 25, we still got some time to go here.
Yeah, it's just also so interesting to point out that the Fed didn't change their tune. Like, they were still talking about, we want to see more progress, we want to wait. It was the markets that changed their reaction function. So after we've kind of cleaned out positioning here, are we sort of on the same page, markets, bond markets, equity markets, and the Fed?
Yeah, I mean, we're getting there. We want to be patient here as it relates to bonds. We're seeing a lot of volatility across high quality bonds here. again, the data continue to chop around. We do want to lean into duration, into high quality bonds here. But again, it's not going to happen in a straight line. And we've seen some massive moves. This is type of volatility around bonds is not normal. So we want to be patient here, but we do continue to like the income that's available, the aggregate bond index yielding close to 5%. We like the idea of locking in that income stream for years. Even if you're not getting paid yet on the duration component, you're still getting that income, which we think is really attractive in an environment where an economic contraction is likely in our view.
So, Emily, let's flash back to a week ago Monday. What did you and the good folks up at John Hancock Investment Management, what did you make about the volatility we saw on last Monday's trading?
It was so remarkable. And, everybody was kind of thinking about the smoking gun. Was it that ISM manufacturing data? Was it initial claims jumping? Of course, everybody scrambled to try and explain the yen carry trade to all of their clients and the unwind of that and the surprise move from the Bank of Japan. But I'll tell you, the one thing that you couldn't point to was earnings. And over time, we all know that stock prices are going to follow profits. And we look at earnings season, we're up about 12% year over year. Still a couple of big names to report here, but earnings have come in pretty solid. I think the challenge for investors on the earnings front is just this impressive run up in prices that we saw prior to the earnings report. So you almost had to be perfect in order to see an outsized reaction from markets there. But earnings growth continues to come in solid. It's being driven by those mega cap tech names, communication services up there as well. We're seeing some broadening out in earnings. So the fundamental backdrop is remaining intact, which makes us, pretty optimistic on the equity front.
Does it also make us much more sensitive then to NVIDIA's earnings, since that's going to be one of the big earnings catalysts? I mean, you get Walmart on Thursday, I get that, but is it now like an NVIDIA story for earnings and the market?
Absolutely. And it's, it's funny how NVIDIA is so far delayed versus everything else. You kind of think that earnings season's over, and then you remember that this massive driver of the market is still yet to report. So that's really going to be, I think, the next big event, coming up in a couple of weeks. Watching that, obviously, it's been incredibly important to markets, especially on the U.S. equity front. So we'll learn a lot from that report. Absolutely.
Some people were talking to us earlier today about small cap stocks. If we are, in fact, going to see some rates coming down, this could maybe be an opportunity for small caps to perform. Are you willing to make that leap? Does that seem reasonable?
And some of the small cap earnings weren't terrible. They delivered.
Yep, some of them did. But overall, if you look at small cap earnings, they're negative for this quarter versus large and mid cap equities. So we think it's a bit early to lean into small caps here. We would be looking for a shift into an early cycle environment. So we'd want that contraction to play out. We never really bought into the idea of lower rates helping small cap equities. In fact, we have to remember that when rates are coming down and the Fed's cutting, it's because something not great is going on, and that should not benefit the more cyclical areas of the market. Small caps feature a lot of stocks that are unprofitable, some growth at any price names. In fact, about 2/3 of the Russell 2000 index is comprised of companies that don't make money. Those names, again, they can rip when cyclicality is rewarded in an early cycle environment, but we simply think it's too early to lean in there. We'd be moving up in cap. We'd be embracing quality. We want companies with great balance sheets, tons of cash, great margins. Remember, yes, inflation coming down is great news for sure, especially for the consumer, but it also means revenue growth is slowing. So again, we want to lean into quality